I welcome Vice Chairman of Hyderabad Branch, CA Deepak Ladda, Treasurer of Hyderabad Branch, CA Rajambal, Sikasa Chairperson, CA A.C.S. Reddy Garu, immediate past chairman, CA Pankaj Trivedi in his absentia. Once again, welcome to today's speaker, senior members and other delegates. I request Vice Chairman to give overview of the today's program, please.
Thank you, Secretary Sir. Good evening, members. I heartfully welcome all the members to today's important seminar on latest amendment in income tax relevant to tax audit. I welcome Speaker of the Day, CA Gururaj Acharya Sir. Sir, welcome to Hyderabad virtually, sir. I also thank Sir for kindly agreeing to an invitation of Hyderabad branch and taking out time from his busy schedule and consenting to address Hyderabad branch member. In fact, Sir only has suggested this topic, and we really thank you. And I'm sure member will benefit from the today's sessions. Friends, as we all are gearing up for the filing of tax returns and completing audits, it is of our most importance to incorporate amendments in our workings and report accordingly where our regulators require us to do that. At times, unknowingly or due to work pressure, we miss certain deadlines or certain amendments or changes. To remove this difficulty, we have expert speaker CA Gururaj Acharya Sir with us today, who will take us through the important latest amendments which are relevant for tax audit for the current assessment year which we are doing the audit. Sir is real Acharya and he tells the subject with so much clarity, and the way Sir linked different provisions of the Act is very remarkable. It shows his command on the subject. In last couple of years, I have heard Sir many times, and every time I listen to him, my respect to Sir goes up. Really thank you once again, Sir, and all the CA11 members for joining the seminar of Hyderabad branch in large number and making it successful. Thank you for the opportunity, Secretary Sir. Back to you.
Thank you, Deepak. I welcome our immediate past chairman, CA Pankaj Trivedi Sir, on the screen. Now I request Treasurer of Hyderabad branch, CA MS Rajambal, to introduce today's speaker, please. Seems some technical issue. Raja? 1 minute, excuse me. Deepak, can you please check it?
Yes, sir.
Yeah.
CA Gururaj Acharya Sir hails from the temple town Udupi, brought up in the iron city of Bellary, and now is well settled in the knowledge city of Bangalore. He qualified chartered accountancy and after completing articles from Mr. Guru Prasad and Company Bellary. He is presently partner of KG Acharya and Company Chartered Accountants Bangalore, specializing in corporate finance, corporate tax, and company law. He is ACMA, FCA, and BCom. He is a rank holder in his academic in the past. He was first rank in the BCom and in the CA Intermediate 21st All India rank, and final in the CA final he was 10th rank. In ICWA exam also, in his CA Inter, Sir was the first rank holder, and for the ICWA final, Sir was the third rank holder. Sir is a member of the Bangalore Financial Reporting Review Group formulated under Financial Reporting Review Board of ICI, New Delhi. Sir was a director on the Board of Directors of State Bank of Mysore, erstwhile Mysore, now merged into SBI. Sir was a member of the Karnataka State Level Audit Advisory Board. Sir was also co-opted member of Expert Advisory Committee and Committee on Accounting Standards for Local Body by ICI, New Delhi. Sir has also authored a book titled Internal Financial Control Practical Handbook on Audit Report on What Can Go Wrong, published by Karnataka State Chartered Accountants Association. Sir is a regular resource person on various subjects, including accounting standards and auditing standards on auditing, Companies Act 2013 and LLP, corporate finance and financial analysis, corporate and tax audit. With this, I present CA Gururaj Acharya Sir before the August audience. Sir, the screen is all yours, sir.
Good evening to all the pearls in front of me. I should say I am slightly, sometimes I become jealous. How is that all the pearls are located in only one city? You know, that way Team Hyderabad is doing a great job. I've been watching Team Hyderabad And last year, I remember Pankaj Bhai doing an excellent job. And this time the chairman is doing so excellent a job that he has just left the team for whatever reason, rather than himself coming on the screen. So that way, thanks to Deepak Bhai, the vice chairman, Satish, the secretary, Rajambal, the the treasurer, and of course, a very nice name. Just now I saw ACSFCA, Reddy Garu. So wish ICMA also was there. That's the specialty of Andhra and Telangana. You have a big surname, have a big initial. So Reddy Garu, thank you. And of course, always a privilege to be with Pankaj Bhai. So what I taught today is we will deal with the latest amendments, which will be relevant not only for the tax audit for the last year, but also for the tax audit of this year, when we are proceeding to give suggestions to our clients. So we need to upgrade ourselves to tell our clients what compliances they are required to do for the year. A lot of changes are there. So instead of going clause by clause, which we have already been familiar with, I think that is more to do with the juniors in the office. So let us concentrate on the latest amendments, which will be, of course, relevant for tax audit and also taxation in general. So I will be talking about the changes in due dates. I will be talking about the changes in due dates, the important notifications that have come out from the last year till now, which will be relevant for us to carry out the tax audit. And the Finance Act 2021, the budget 2021, which was presented on 1st February 2021, there are certain provisions which have a retrospective effect, which will be having an implication for the tax audit that we are going to do. So we'll be looking into that. Then we will also look into the amended clauses in Form 3CD. Form 3CD has got amended. There are at least 6 changes which have been incorporated in Form 3CD. We will understand the rationale behind those changes, and then it will be easier for us to answer the respective clauses. We'll also get into the changes in TDS and TCS provisions, because we have to answer as a tax auditor clause 34A, which is a very loaded question. In fact, that I would put that all the questions in 3CD is on one side, clause 34A dealing with the TDS is on the other side. Pankaj Bhai, it is like putting one Tulasi Dala, that is the basil leaf, on the one side, and Rukmini Satyabhama going up for Krishna. It is like that. So where 3CD, the for clause 34A dealing with TDS is really a loaded question. In fact, I remember T.N. Manoharan sir, when he was the president, this particular question came out. He was very much against this question getting incorporated in 3CD, because he wanted to have the TDS audit itself as a separate thing. TDS audit itself is a separate thing, because it is so much loaded in that question. So we need to understand TDS very easily. If you imagine a company doing so many transactions, very easy for the tax auditor to miss out a couple of reporting on TDS aspects. So let's be very careful, understand the changes in the TDS and TCS provisions. And finally, I will also be touching on the income computation and disclosure standards. So this is the menu for the day. So before I put up the presentation, I have requested Deepak that at least 3 or 4 people should be there on the screen at any given point of time, so that we can have on an interactive basis. Having said that, I would request all the participants to be active by typing out their questions in the chat box or Q&A box, so that Deepak or Satish can read out the questions, and I will be, by now you must be knowing my style. I will be coming every half an hour to a question station, and I will request you to ask those questions at those stations, so that we will exchange the views. So it will be more like an interaction rather than a monologue from my side. Now, before I get into the topic specifically, I thought a few important things which are relevant for the current time. Some of us must have lost our clients to COVID. And so therefore, we always say that there are only 2 things very certain in life. One is death and the other one is taxation. Now, one is death and another one is taxation. But have you heard of a deadly taxation? Taxation can be in that sense. I was some senior chartered accountant told me about the quotation from Nani Palkevela, Nani Palkewala has told, it seems, I have not read that in that book, but he was quoting Nani Palkewala, the income tax officer is the only person who can murder and get away, murder a person and get away. Even the president of India does not have this particular power. So the income tax officer has the power to murder a person in that sense. I mean, if he sends a notice, you know what is the implication on the assessee. So I don't know whether the assessee will die or not, but the chartered accountants we will of course have to face the music. So that, having said that, we were talking about death. Now, in the case of a partnership firm, I mean, I'm coming to a very serious point. In the case of a partnership firm, if there are two partners and one of the partner dies, what is the implication? What is the implication? Let us understand the seriousness of the situation. When there are, of course, when there are three partners or more than two partners, if one of them dies, the firm continues. But very interestingly, Pankaj Bhai, that if there are only two partners and one of them dies, the firm is deemed to be dissolved. The firm is deemed to be dissolved, notwithstanding a clause in the partnership firm stating that the death of one partner does not tantamount to dissolution. Maybe the sons or the legal heirs, one of the legal heirs of that particular partner would be inducted as a partner, and the firm will continue as a going concern. Notwithstanding that clauses, the Supreme Court, I mean, I can give you the citation, Parvati Ammal versus CIT, 1987, ITR 161. So in this particular case, they went on to say that the firm consisting of only two partners on account of the death of a part, the firm automatically gets dissolved. It was again reiterated by the Supreme Court in the case of Seth Govindaram Sugar Mills. Reported in AIR 1966 Supreme Court 24, the saying that the new partner who gets inducted by virtue, let us say A and B are there, A dies, A's son C gets inducted, so B and C carrying on the firm, although C comes in as a new partner, it will be considered as a new partnership firm. Now imagine if such a firm has got huge immovable properties. All of them will have to go through the capital gains and things like that. So therefore, what is the learning experience? I thought this is a very important occasion. Although we are talking about tax audit, it is important to talk about all the aspects of taxation. As advisors, it becomes our responsibility, having known these particular provisions, to tell our clients not to have only two partners in a firm, especially if the firm is heavily loaded in terms of assets. I mean, if it is only a business not loaded in terms of assets, like in the case of a chartered accountant's firm, I mean, I would see that there would be no problem even if the firm is dissolved. There would be no big implication in that sense. But if the firm is asset heavy, then I think it is definitely good to tell our clients to have at least three partners, and hoping that two of them will not die together. I mean, that's the point to be noted. So this particular thing will also be, I mean, once we are talking about the partnership firm, we are now making it a policy in our office to tell, even in the case of a private limited company, if there are two directors or two shareholders, to tell them that let us have a minimum of three shareholders and three directors, because if something happens to one, although in the case of a partnership, a private limited company, the issue will not tantamount to dissolution per se, it will have its own complications as to how do you, when one of the shareholder dies out of the two, who conducts the AGM and all those practical issues. Although we have overcome all those things, it is easier to have three shareholders. We can tell the two that you bring in your respective wives or respective children, so that we can have more and have a continuity in place. So that is the first issue I wanted to talk about. The second issue, which is also very interesting, is, Satish Bhai, let me tell you that if all of us are aware of section 54F, the capital gains, if whenever you sell a property, you have to invest in another property. And in case you don't invest in that particular property by the due date of filing your income tax return, you will have to deposit that money in a capital gains account scheme. You'll have to deposit that money in a capital gains account scheme. Now, the person A, I mean, let me tell you, Mr. A, who has deposited in the capital gains account scheme, you know, we have got 2 years time or 3 years time as the case may be. I'm not on that point. The point I'm on that is where the person has deposited in a capital gains account scheme, he dies. Now the person who has deposited in the capital gains account scheme, he dies. So what is the implication of such a person's death on the legal heirs? So there can be only two options. Either the legal heirs have to comply with whatever obligation was there on the original person, that is Mr. A, or it is tax free. Okay. So what is your view, Mr. Satish, or anybody? I mean,
the legal heir will have to pay tax if it does not buy the property in that aforesaid time. Whenever he withdraw in the year, it will be taxable. The same provision to the erstwhile member, in my opinion, will continue.
Yeah. Any other different views?
Yeah, CA Trinadra replied, sir, her legal heirs come into picture.
Yeah.
One more member, Mr. Shankar replied, tax free.
What is the basis? What is the basis to say it is tax free in that sense? Now, Deepak, let me tell you, in a normal course, that is the thinking. You know, income tax will not consider death of a person. So therefore, even if the person dies, his legal heirs, if they have two options, either to withdraw the money, pay the taxes, or to comply with the promise which Mr. A has told to the income tax department that he will buy or sell. Here, for a change, the income tax department is benevolent. You will have to refer to say circular number 743. Circular number 743, given out on as early as in 1996, 6th of May 1996, which talks about a very benevolent provision, which goes on to say that in the event of a death of a person, the legal heirs can withdraw the money without there being any compulsion on them to comply with the purchase or construction of the house property. So that's a thing. In the case of a death, a benevolent provision has been built in. I mean, I was just trying to understand the logic behind it. Imagine Mr. A had his wife and 2 children or 3 children, and he had to construct the house as an obligation. And if at all they had to construct the house just for the sake of meeting Mr. A's obligation, then how will all the 4 of them again share that particular house property? I mean, maybe considering these difficulties, I mean, it will become easier if you understand the logic behind it. When I was trying to understand the logic, so therefore the department has, and taxing them for a thing which they are not obligated to is also not right. So therefore this circular number 743 of 1996 gives a benevolent provision as far as the surviving legal heirs are concerned. Let's go to another very interesting situation. All of us are aware of the provisions of set-off. I mean, one of the interesting things about set-off is that whenever the loss that is incurred for the year, loss that is incurred for the year has to be set off against the concerned head. And if it is brought forward, then it has to be set off against the same head of income, Now that is very clear. Now, one of the situations that came out was during the year, there was capital gains. I mean, let us say in assessment year 21-22, financial year 2021, there was a capital gain of about 1 crore. Okay. And there was no capital loss for him to set off. But he had brought forward business loss. All of us are aware that brought forward depreciation takes the character of a current year depreciation. And therefore, current year depreciation could be set off against any loss of the year. So that being apart, let us now talk about there being no brought forward depreciation. It was a normal business loss of the previous year. And I had a brought forward business loss of 60 lakhs and a current year capital gains of 1 crore. Now, can I set off the brought forward business loss against the capital gains? if you see, I mean, Narsi Reddy also says no. Srinath also says no. I mean, there are a lot of chats coming out. That's nice that people are involving to a great extent. I mean, sometimes we feel that the speaker is the only person who's too involved. Today, therefore, I made all the team Hyderabad sort of involved. Having said that, now, Section 72, subsection 1, clause 1 goes on to say, if you read the plain reading, it goes on to say it is not possible. I mean, this is how we were thinking for a very, very long time. For a very, very long time, we were thinking that the 1 crore capital gains and 60 lakhs business loss, I could have set off the business loss brought forward against the business profit of the current year. But capital gains cannot be used to set off the business loss of the brought forward situation. Recently, Karnataka High Court reported in 128 Taxman 267, when in the case of Nandi Steels Limited, which was argued by my good friend A. Shankar, very beautifully the argument was made, and there they said that you can set off the brought forward business loss against the capital gains of the current year. But is it not going against the provisions of section 72 clause subsection 1 clause 1? There, if you open up 72.1.1, it says that you will be able to set off the, as long as it is a business asset. I mean, let me tell you, section 72.1 employs the expression computation under the head profits and gains or profession. 72 subsection 1 uses the word head, whereas 72.1.1 does not use the expression head. That means capital gains can be used as long as it is a business asset. If this particular asset is used for the purpose of business, you can still claim it, not necessarily under the head business and profession. So that's a wonderful analogy that has been drawn out. If you open up 72.1.1, you will not see the word, they have not used the word head of business. I mean, they have not used the word. So as long as the asset is pertaining to the business, it may be taxed under the head of business income. So you can still claim. Now, what they are trying to say is your brought forward business loss can be set off against a business income. So what was proved to the court is this capital gains was a business income. Can you understand this, Pankaj Bhai? I mean, are you appreciating this point? So what they told is this particular capital asset, as long as this asset belongs to the business, you are selling that particular asset. From a businessman's point of view, is it a business income? Yes or no?
Yes.
It is from the income tax point of view, it is not taxed under the head income from business. From a businessman's point of view, it is a business income. So 72.1.1 says the brought forward business loss can be set off only against a business income. They did not, I mean, income from business. They did not use the word can be set off only against the under the heading income from business and profession. So since the word heading was missing, and in the normal business sense, beautifully, because now to the, I mean, it is very, when you are arguing is this before the, let me say the income tax officer or the commissioner appeals or the tribunal also, they are so much familiar with the heads of income that they may not be able to appreciate this. They will probably import the word head of income. It is easier for us to probably, for us, matlab, unfortunately, I and you cannot argue before the High Court. That is why Shankar, who gave up his practice as a chartered accountant and became an advocate. I mean, they become restless to that extent. And they are the ones who can easily convince the general court, because they deal with murder to, criminal offense to this thing. And they say whether by sale of a land and building of a company, by selling a land and building of a company, is it a business income or a personal income? They'll go to that. It is a business income. So the section 72(1)(1) says brought forward business loss can be set off against business income. Finish. Case closed. So, I mean, I'm just trying to tell that this is how, yes, Pankaj.
No, a couple of questions. Yeah, frankly, excellent point. I'm still in that maze now. I'm still thinking how we could have missed this for so many years. Thank you very much. But I think some of the questions which are constantly coming are, should that asset be a depreciable asset or a non-depreciable asset can also do? And the second point, I think many of them have commented is that income tax return is not allowing that. So any just light can you throw on that particular point?
No, I mean, income tax return may not see. Again, I always keep telling, the income tax return cannot dictate the Income Tax Act.
No.
That's a point we have to tell. That there can be, the income tax return is not approved by the President of India and the Parliament. So it is the Income Tax Act which has been approved. So therefore, the return should follow the act and not the other way around.
Right.
That's the first point. As far as the second point which you mentioned, should it be depreciable or non-depreciable? Again, that is not a point for a businessman. As long as it is a business asset, sir, let me tell you very honestly why you and I probably could have taken advantage of when we feel that this is a case which has come where so many assessees have actually done very bad in their business, had a lot of losses in their business, because of which they had to sell the property to repay the bank loans or any creditors and things like that. This could be a very normal situation. So therefore, this judgment has come in as a great relief. I think we should take it before the amendment happens in the Income Tax Act by the introduction of the word heading. That is what I would say.
And here that promise of no retrospective amendment should
that
be
I think
a great
definitely
rescue.
No. That definitely will happen. Now, what you saw, what happened if they do a retrospective effect? The case of Cairn and Vodafone, the government is begging them to withdraw the cases and they are at their mercy. Now, having said that, I think this is a beneficial provision which I thought can make a lot of difference to a lot of our clients. So this is a thing which we need to discuss beyond tax audit. I mean, that's why I said when Deepak said, let's talk about tax audit, there are tax audit, you can ask any junior to talk, but then let us talk about serious things which will make a difference to our lives and to the lives of a lot of our clients. Now, the fourth point, sir, is
Sir, they want just the case law. I think it's Nandi Steels, 128, Taxman 267.
Correct. I mean, it has come out in the Karnataka judgment. This came out in the month of July. In the month of July, recent judgment, that is. The next point, sir. And there they have quoted very nicely. I mean, they have gone to various, they have referred to a Supreme Court decision on Kokanada Rajeshwari Bank Limited. I mean, once you refer to that judgment, you will get a host of ideas to say they've used a legal maxim, Latin word called unius est exclusion alturius. I mean, what does finally that means? Pankaj bhai, a thing like this, I am sure you appreciate such things. For an interview, one of the person was called and asked, what is the meaning of, what do you mean by unius est exclusion alturius? What do you mean by? The chartered accountant was asked to come for an interview and he was asked this. He said, he thought about it. He knew that he has not seen this word maxim anywhere before. The question was, what do you mean by that particular maxim? He said, that means, sir, I don't get the job. That means a very, very practical way of answering. I mean, I don't know. That means I don't get the job. If that is the criteria for me to get the job, then I don't get the job. And having said that, so this unius est exclusion alturius, which was explained to the court in the case of GVK Industries to the Supreme Court, that an express mention of one thing implies the exclusion of the another. So wherever they have used a particular word in so many places, and if they have excluded it in a particular place, that means the parliament must have very thoughtfully done that. Although we know how thoughtful it could be. Maybe they have actually missed out. That's a point to be debated outside the court. Having said that, we come to the fourth point, very interesting issue is on 80JJAA. I mean, now we are hitting the border of tax audit. 80JJAA is a very important deduction which every businessman entitled to can claim. Now, who is entitled to is a very important point. First of all, if you are a company coming under the optional sections of 115 BAA or BAB, can you claim 80 JJAA? Can you claim 80 JJAA? Satyanarayana Murthy says yes. Now let me tell you, until last year, that means the financial year 1920, when for the first time 115 BAA, BAB came, they said you can come under a 22% rate or a 15% rate, as the case may be, 115 BAA, BAB respectively. But you will have to give up a lot of exemptions and deductions. Now, we have seen that. I'm not getting into the details of that. But what is said is, with respect to Chapter 6A, only Part C, that means the income-based deductions, you could not claim for 1920. Expenditure-based deductions, such as 80G, could have still been claimed in 1920. But let me tell you, in 2021, from financial year 2021, if you are coming under 115 BAA or BAB, for that matter, BAC and BAD also. BAC is for individuals who are opting for the reduced rate of taxation, or BAD with respect to cooperative societies. They cannot for and from the financial year 2021, they cannot claim any deduction under Chapter 6A. Any deduction under Chapter 6A, excepting 80 JJAA, excepting Section 80M. I mean, 80M I will talk a bit later. Now I'm talking about 80 JJAA. So which means 80 JJAA is a beautiful section which benefit can be claimed even by companies which are paying 22%, 15%. Although 80G is removed, let me tell you that all Section 80G is gone for BAA, BAB, BAC, BAD. You cannot claim any 80 deduction excepting 80 JJAA, 80M. There is one 80 LMA which is for very rare situations, gift city and things like that. I'm not talking about that. Now let's concentrate on 80 JJAA. Let us refresh our 80 JJAA conditions. It is a deduction available to meet the 30% of the expenditure paid toward salaries paid towards new employees. 30% or 30% of the salary which is paid in a particular year can be claimed in that year plus the 2 years, the next 2 years at the rate of 30%. And there are certain conditions. What are the conditions? Condition number 1, the employee salary should be less than 25,000. If he is covered more than 25,000 rupees, you cannot consider him for 80 JJAA. They can be new, but they are not coming under 80 JJAA. Second condition is all of them have to be covered under Provident Fund. All of them must have been covered under Provident Fund. Point number three is they should be paid salary in permitted modes. What is permitted modes? Somebody is saying company must be engaged in manufacturing. Srinathji, that is removed. I mean, it was initially that condition was there. Today, a service provider, professional can also claim 80 JJAA. Even your office and my office can claim 80 JJAA, provided all the conditions are complied with. Okay, as long as he's subject to tax audit, that's the right thing. He should be subject. The assessee should be subject to audit under Section 44AB. He should be subject to audit under 44AB. Now, the fourth condition is the new employee should have worked for at least 240 days. He should have worked for 240 days in the new year, except for 3 types of industry. 240 days is replaced with 150 days. That is for apparel, footwear, and leather products. Apparel, footwear, and leather products, they have reduced it to 150 days. However, a beneficial provision has been given. Suppose an employee is appointed in the month of January. So for that year, he would have worked for 90 days. But in the next year, if he works for 240 days, he can be considered as a new employee in the next year, but not in the first year. So you can give the benefit next year. Now there are 3 or 4 issues that I would like to raise up. Recently, one of the tedious, one of the survey happened in one of the companies called Quest Corp. I mean, it's a leading company. You must be aware, having wide coverage, Quest Corp. And there, the income tax department raised a big demand on the assessee. Some 2,000 crores of claim has happened. So we would like to, an unlawful claim has happened. So they raised 3 points. Along with the 3 points, I would like to add another 4th point, 4 issues I would like to raise on 80JJAA, which we should be aware of. Point number 1, the company said employee salary of 25,000 rupees is meant as average salary. That means if in a particular month, a salary, the employee was drawing 20,000, but in the last month he was drawing 30,000, but on an average it was less than 25,000 rupees. The company claimed that it is good for 80JJAA. But the department said the word average is missing in the 80JJAA. So therefore, this point is wrong. What is your view, sir? Is the company right or department right?
I don't know, because income tax department never goes with logic. I think income tax department has
I somehow feel that the department is right on this point, because the wording used is the salary should not be more than 25,000. They did not use the word average. Since the word average is not present in the act, I think taking the benefit of that average may be a difficult proposition as a chartered accountant to argue. But as an advocate, as I told you, when you go to the High Court, you can probably win over. So I for one, am in favor of the department as far as this point is concerned. It could be debatable. Yes, sir.
But can we say for 240 days at least he was paid 25,000?
Yeah, that's a very good point. Fantastic. So you are coming to the average of the two. Fantastic, sir. You have averaged the average and the full year. Coming to 240 days, I have paid him so and so. Therefore, he should be given. While that could be an argument, but I'm still.
Srinath.
I think
Srinath
ji has said 25,000 rupees per month. So 25,000. Therefore, I agree with Srinath's view and the department's view on this point. The second point of disagreement between the department and the SSC when the survey happened on 80JJAA was the department said 25,000 rupees should be including reimbursements. Reimbursement of telephone expenditure or travel expenditure or conveyance expenditure. This I vehemently oppose. I mean, what is a reimbursement? Reimbursement, after all, I mean, we should also understand how we account it in the books of our accounts. The reimbursements on telephone, etc., should not be clubbed as salary expenditure. It should go to the communication expenditure. I mean, it should go to the concerned expenditure. Having talked about communication, I would like to take up a slightly deviation. Whether iPad is an item which is considered as a computer.
No,
eligible for 40% depreciation, or iPad and iPhone should come under 15% depreciation.
Recent judgment
they have held that iPad is only a communication equipment and not a computing equipment. Therefore, that should come under 15% depreciation. I mean, I would always try to say that we should not go by the terminology. Of course, the department goes by the terminology. We should impress upon the department or the courts. That is, as we go, I think this was held by the tribunal. I mean, I would try when it goes to the High Court, if I were to argue, I will say, go by the substance. After all, ICDS also recognizes substance over form. I mean, all these days it was there in accounting standards. It has now come into substance over form. Why the hell is computer given earlier a 60% depreciation, now a 40% depreciation? Because after 3 years, the computer will have no value. In the same analogy, iPad also, after 3 years, you don't even know where it is. I mean, in that sense, so we should use that particular logic to say communication or computing, it requires the same treatment as like a computer. So having said that, now this becomes a difficult thing, but if there is some iPad in the books of accounts, it's better to discuss with the client and tell him that I would put it under a communication equipment rather than as a computer and claim only 15% depreciation. So the second condition was with respect to the reimbursement, which in my opinion, the department is wrong. Okay. And I'm sure all of you agree with that point. The third point, which is very interesting.
Irrespective of the method of accounting, sir, even if suppose I treat it as salary, still is it wrong?
I think if you treat it as salary, you are only agreeing to the fact that it is salary. I mean, what I mean by that is, let us say I am giving conveyance of 2,000 rupees, if whether or not he incurs it. I am giving a communication allowance, whether or not he uses it. You know, he may be using only 400 rupees, but I am giving 2,000 rupees communication allowance. Then I am afraid that it would be part of the salary and the department will be right. I think you brought out a very good point. So therefore, reimbursement should be of a case of a pure reimbursement and not a case of build up or CTC types in that context. And accounting also, I would say, should follow in that direction so that it be above board. Okay. Right. So let's now talk about the third issue which the department raised out, was to say that the employee should be there. All of us are aware that if I am paying 10 lakh rupees as a new employee towards 100 employees, I have 10 lakh rupees is the total salary I paid to 100 new employees. I can claim 3 lakh rupees this year, 3 lakh next year, 3 lakh afterwards. Now, let us say for a moment, out of these 100 employees, I mean, there are no new employees added to the year 2, year 3, but out of 100 employees, 50 people left in year 2. 50 people left in year 2. Can you still continue the claim of 30% of those 50 employees in year 2 and year 3? Yeah, Deepak, you are muted, Deepak.
In my opinion, yes, sir.
Yes.
The condition of continuity is not there. Perfect.
The condition of the employee being there for 40 days or 150 days is very clearly told. So that means it is a condition at the beginning, and condition of continuity is not told anywhere. Now, this is what has happened in the case of this particular company, and they have vehemently opposed. The department is trying to import their common sense into the Income Tax Act. I mean, if you are claiming and that there's no employee, how can you claim? How can you claim? I mean, I can claim because it is there in the act. And do you want me to explain the logic? I can explain the logic also. What the department, the intellectuals who framed this particular section had in their mind was, they wanted to give 90% of that particular benefit of the first year employee to this is a employee generation incentive, an incentive given for generating employment. They said, I will give you 190% of the salary as a relief, 100% under section 37 or whatever, and 90% under 80JJAA. But then they thought, instead of giving it in 1 year, we will space it out between 3 years. And therefore, they have not told the condition that subsequent years, even if the employees leave, you can continue. However, let us be very clear. In the subsequent year, if 50 people have left, 100 was there in the new, next year 50 left, and 60 joined. The benefit of 80JJAA will not be available for 60, but it will be available only for the incremental 10. I mean, those are the controls which they have told. But 100 becoming 50 and 50, you don't lose anything. 100 becoming 50 and then 60, you get still a benefit of 10 in year 2 for the next 2 years. So that is how it is. So this is a situation of Quest Corp. Now let's talk about the fourth issue which I now brought out. Now before we go to the fourth issue, we need to understand Finance Act 2021 made one very interesting change in the ceiling for tax audit. Last year they said up to 5 crores turnover, SSC carrying on business need not do tax audit, subject to compliance of less than 5% in cash. I mean, all of us are aware of that section. So let us, for the purpose of the 318 participants, I see 318 participants in Hyderabad, a good number that is. Having said that, for the benefit of all of them, let me recap the 44AB provision. 44AB tax audit is applicable in the case of business and in the case of specified professionals. There are only 2 limits we must understand. In the case of a business, if my turnover is more than 1 crore, I should subject myself to audit under 44AB. Or if I am a specified professional, who is a specified professional as told under 44AA? I mean, it could be a accountant, say pakad ke doctor, engineer, lawyer, including a company secretary, a sports person, a film personality. All of us are aware of 44AA. In the case of a specified professional, if his turnover is more than 50 lakh rupees, he should subject himself to 44AB audit. So these are the only two situations. However, we are aware of another type of audit which comes under 44AD, which says in the case of a 44AD case, if your turnover is up to 2 crores, although 44AB says up beyond 1 crore, you have to subject yourself to audit. 44AD gives a relaxed provision. It says up to 2 crores, you don't have to get yourself audited even in the case of a business, as long as you declare 8% or 6% profit, as the case may be. Now that is 44AD. However, having opted once for 44AD, I mean, this is a liberalized scheme. 44AD is a liberalized scheme which gives you an option of not maintaining books of accounts, not getting it audited. Forget about books of accounts itself is not required, but you have to maintain, I mean, you don't have to maintain books of accounts under 44AD up to 2 crores, as long as you show 8% or 6% profit. Having said that, you have an option of not going under 44AD also. Let me be very clear. Up to 1 crore turnover, if I don't want to go in for 44AD, I will maintain books of accounts and still show less than 8%. Not get it audited also. Not get it audited also. That is one point I don't want to make it clear. Having said that, if I have opted for 44AD once, then I am under an obligation to come under 44AD for the next 5 years. And I have to show this particular 8% or 6% in the next 5 years, failing which I have to get my books of accounts audited. Okay, so that is very clear on 44AD. Now let's come to 44ADA. In the case of 44, yes, Deepak.
So to conclude, so 44AD is applicable only my turnover is above 1 crore, below 2 crores.
No, I'm not saying like that. Your 44AD is up to 2 crores. Up to 2 crores, you are coming under 44AD.
Yes.
As long as you are coming under 8% or 6% profit.
Okay.
Okay. Now yes, up to 1 crore, let us say up to 1 crore, you don't have to get your books of accounts audited.
Yes.
You don't have to get your books of accounts audited up to 1 crore. Then you have an option of, going into 44AD or 44AA maintaining books of accounts. If it is less than 1 crore. If it is less than 1 crore, you decide to maintain books of accounts and not declare 8% or 6%.
Yes.
That means you did not enter 44AD at all.
Yes. Yes.
That is one option available to you. But if you exercised no 44AD, if you say that I don't want to maintain 44AD, up to 1 crore, you have to maintain books of accounts and not get it audited. But beyond 1 crore, you have to get it audited. Okay. But then the point is, once you opted for 44AD, that means you came through the liberalized route. Once you come under liberalized route, you are under an obligation to show 8% or 6%, failing which you have to maintain books of accounts and get it audited. So once you go into that 5 years, you have to continue under that scheme. So that is the picture. Now let's for a moment come to 44ADA. Do we have an option of coming into 44ADA or not in the case of a specified professional? Like in the case of a 44AD case, he does not have an option. In the case of a specified professional, they do not have an option. They must compulsorily show 50% profit, failing which they have to get their books of accounts audited. So they don't have a two-way, maintain books of accounts up to 1 crore and not get it audited, or show 8%, not maintain books of accounts, 44AD. In the case of 44ADA, this option is not available to me. Now, having said the 44AD and 44ADA, let me quickly finish off the other provisions of 44ADA. But anyway, 44ADA, one of the possibilities with 44ADA is you don't have an option. You must compulsorily show 50% profit or get the books of accounts audited. Are we clear? Now we'll forget about presumptive taxation. We will come to 44AB clause A and clause B, 1 crore or 50 lakhs. Now, with respect to 50 lakhs, there is no doubt. I'm removing the professionals, specified professionals. Let's talk about the business. In the case of business, beyond 1 crore, they are supposed to get their books of accounts audited. Now the question is, last year, that means for 1920, they enhanced this particular ceiling. If you are coming under, if you are a specified assessee, I mean, I would put it like that. If you are a specified assessee, your ceiling of 1 crore will go up to 5 crores. That means you must be a businessman, not applicable to specified professionals. You must be a businessman up to 5. That means, and your turnover up to 5 crores need not be subject to audit as long as your total receipts and your total payments, and is double bold, and your total payments are less than 5% in cash. Are we clear? I mean, this we are already used to, is very, so you don't have to get your books of accounts audited under 44AB. Now, what happened in 2021 Finance Act? Finance Act 2021 went on to give a liberalized provision. They changed from 5 crores to 10 crores. Please understand, it came in from 1st February 2021, it was announced and said applicable from 1/4/20. That means for the financial year 2021, 1 crore becoming 5 crores, 5 crore becoming 10 crores. So in the case of a public limited company, private limited company, partnership firm, LLP, or whatever the nature of the organization it is, up to 10 crores, I don't have to do the books of audit under 44AB if and only if my total receipts and my total payments less than 5% is in cash. And they introduced one more very interesting terminology when they passed the finance bill. When it became in the finance bill, it was not there. In the act, it came out. They said that a person who is receiving or paying a check, an open check, that means not account paid check or not account paid draft, is deemed to be cash. Is earlier in 1920 5 crore ceiling, they said less than 5% receipt and payment should be in cash. But now they said less than 5% should be in cash, and open check is also considered to be equivalent to cash. So coming back to the question, up to 10 crores turnover, I don't have to do an audit under 44AB as long as he satisfies these two conditions. Now, this is not my purpose. We are aware of this. Please understand, this ceiling of 10 crores is applicable for the tax audit that we are doing now for 2021. Is it a good thing or a bad thing? Deepak bhai, good or bad? 9C is gone. 9C is gone.
Yes, sir.
9C is gone. 44AB ceilings are going up. Small companies audit, I am told, will not go. Yesterday, our president came on video to say that it is not going to happen. But then, I mean, I'm just telling, good or bad? The audit of 44AB getting abolished, is it good or bad?
Deepak will not answer good because of some obvious reasons, because all other people will not answer as because of obvious reasons.
Oh.
But personally, I have reason to say good because I don't have personal interest. So the way the audit, etc., is designed, I think it's better that it's going out, is my personal opinion.
Karimullah Ray says it is bad. Now let us talk good and bad from whose perspective?
Business, yeah.
Now let us say
Good.
from whose perspective? I mean, this is now talking about ease of doing business, and since now we see that 26 years, whatever changes have happened, all of us are aware. Not only those which were subject to TDS, so many other things are coming in 26 years. The dividends received from anybody, any company, whether or not TDS is done. Interest received from any bank, post office, or a NBFC, whether or not TDS is deducted. Earlier, only that which was subject to TDS was coming in 26 years. So our people were so intelligent that 40,000 rupees tak interest TDS nahi hoga, so split it into different banks. Nobody will know. But then now they brought in that even an SB interest will now come and sit in your 26 years. That means the machine reading, the artificial intelligence, the specified financial transactions coming into picture, all these have enabled the department to collect the information without the intermediation of a books of accounts itself. Forget about audit. So to that extent, they have got the information. Now, having said that, therefore, they wanted to make a ease of business. Ease of business means this 10 crores they increased. Now, I will tell you that if such a particular company whose turnover was 9 crores and they had paid about 1 crore to a new employee, and their taxable profit was, let us say, 3 crores. Taxable profit was 3 crores. 1 crore they had paid to the new employees. 30% of 1 crore will come to 30 lakhs. So out of that gross total income of 3 crores, can they claim this 30 lakhs as a deduction under 80JJAA? This company is not subject to audit because they have come under the benevolent provision of, they have come to the benevolent provision. This is a benevolent provision.
No, because tax audit is mandatory.
No, look at this, sir. If you open up 80JJAA, it starts with a company which is subject to audit. I mean, that is how it goes on to say, where the gross total income of an assessee to whom section 44AB applies. Now, does 44AB apply to this company which is doing 9 crores turnover? He is coming out of 44AB by virtue of the proviso. By virtue of the proviso, 44AB does not apply to him. Now, unfortunately, this person who is supposed to be a very compliant company, not taking in cash, not paying in cash, to get the benefit of 80JJAA, can he therefore get it audited and claim it?
Yes.
Can he get it audited and claim it? The answer is no, sir. I mean, if you are getting it audited means the department will say you have done it for your whims and fancies. You are not coming under 44AB. You are not coming under 44AB. You are forcing yourself to come under 44AB. The best way to force yourself to come under 44AB is give a 50 lakhs cash or take 50 lakhs cash. But what I'm saying is you are forced to do some transactions. We have made a representation to this extent, saying that a benevolent provision should be benevolent to its fullest extent, not in parts. I mean, that is the point we have made a representation and told. But for the moment, if such an assessee is eligible under 80JJAA, by virtue of his not being subject to 44AB audit, he will be out of the claim. He cannot claim this. That's the unfortunate thing that is told there. Okay. So these are my initial remarks, unless you have anything to add, or we can take up questions before I put up my presentations on other matters. Any questions?
Yes, Pankaj sir, please proceed.
There are questions, Deepak. Lot of questions, sir.
Yes, sir.
Yeah.
Srinath says in the first year of claim, if there was tax audit and there is no problem. What about the consecutive years for claiming?
So, okay, what he says is he's coming in the first year under 44AB. So he did a 44AB. In the second year, he did not have to come under 44AB. So at that stage, he had an option either to go under 44AA, maintain books of accounts, or come under 44AD. So if he chooses to go in for books of accounts, he can continue that route, maintain books of accounts altogether. Or he comes under 44AD, means he has to come under 44AD for the next 5 years. You're muted, Deepak. Yeah.
Does the benefit of 44ADA extend to the partners of the firm?
Very, very good question. So what is meant by this? Let me explain you, maybe for the benefit. I mean, this is an FAQ as far as I am concerned. I am a partner in a firm from which I am getting 44 lakhs as remuneration and 3 lakhs as interest. So 47 lakhs is my total. That is my total receipt. That's it. I don't have any other. So I am a specified professional because I am a chartered accountant. Now, having received this 47 lakhs, can I opt for 50% of 47 lakhs as my income? That is a question. Can I go in for? The answer is an emphatic yes. You can go in for 44 ADA, but let me be very clear. 44 ADA does not say 50% profit. It says 50% or such other sum as may be claimed to have been earned by the assessee. Just as 8% does not mean 8% of the turnover is my profit. If the real profit, I mean, in the case of 47 lakhs, let me come back to that. In the case of 47 lakhs, what expenditure as a partner will I incur afterwards? What other expenditure? What other expenditure to earn that particular salary and interest would I have incurred? If there is a genuine expenditure of 4 or 5 lakhs, let us say I have a car in my individual name, I am claiming depreciation, the insurance for that particular car, the driver for that car which is not paid by the firm. Now those things I can claim it, but that does not mean maybe all these things put together will be 4 or 5 lakhs. So 47 minus 5, 42 lakhs. Maybe if I borrowed interest to earn this particular interest on capital, I can still claim that. But having said that, if you think that 47 into 50%, somewhere I read this particular beautiful quote, which said that section 44 AD and 44 ADA, let me take the example of 44 AD does not give you a license to create black money. It does not give you a license to create black money, which means, let us say my turnover is 90 lakhs and 8% of that is 7,20,000 rupees, but I have actually earned 50 lakhs profit. I have actually earned 50 lakhs profit. If you show that 8% it is what it is telling, that therefore 7,20,000 I am offering for tax, 50 minus 7.2 lakhs will be subject to tax under 115 BBE at the rate of 78%. So in short, 44 AD or ADA is not a license to create unaccounted money in that sense.
Correct.
Now, as a corollary, let me tell you, in this particular, he was a partner. Deepak is a partner. Deepak and let us say Pankaj are partners in two firms, in a firm, and the firm is subject to audit under 44 ADA. I mean 44 AB clause B. They were because the firm's turnover is more than 50 lakhs. Firm is subject to tax audit. Now, Deepak, a partner of the firm, will get remuneration of 60 lakhs, and interest of 5 lakhs. So totally 65 lakhs. Should Deepak be subject to tax audit under 44 AB?
In fact, my opinion is yes, sir. Because I'm taking a slightly different analogy also, same thing. Okay, instead of chartered accountant, let us say a lawyer with the big law firms are having partners giving them 1%, 2% share. And these partners maintain their individual offices in some other cities and they do spend a lot of money. So in that case, we thought it's better to have a tax audit done and then file the return. So because it's profession.
Yeah. So you are doing it out of the requirement of the act or doing it voluntarily? That's the question.
Benefit of the client.
Benefit of the client. Now, benefit of the auditor, maybe. Also because it's now let me tell you the law, sir. The law is very clear. In this case, Deepak is deriving more than Deepak. Is he a specified professional? The answer is yes. Is he deriving more than 50%, 50 lakh rupees turnover? The answer is yes. I mean, it doesn't talk about only turnover, sir. If you see 44 AB or ADA, gross receipt or sales. So that means, is his gross receipt more than 50 lakhs? The answer is yes. So therefore, tribunals have held very categorically that this, in the case of this particular person, he should be subject to tax audit. In fact, in my own personal individual capacity, I am a partner of the firm. I am subjecting myself to tax audit even in my individual capacity. That is the right thing to do. Okay. So no. we were talking about 40. Any other questions? Any other questions before I go to?
Deepak, there are few questions in Q&A also. I have just removed the answers if you can read it from there.
Okay, sir. Shall we take questions now only or shall we take at the end?
Whichever. Okay. Okay. Then we'll take it at the end. I will just come to one more interesting point on 44 ADA. Let us say I took the example of 60 lakhs turnover and 5 lakhs of interest. 60 lakhs salary and 5 lakhs of interest. Let me slightly change the example to 30 lakhs salary, 2 lakhs interest, and 10 lakhs and 20 lakhs of share in the partnership firm. So salary is 30 lakhs, interest is 2 lakhs. So 32 lakhs is the taxable portion, but 20 lakhs I have received. 20 lakhs I have received as share of profit in my firm. So if I add this 20 lakhs, it becomes 52 lakhs and it crosses my 50 lakh ceiling. So in short, in the first example, the taxable income itself was crossing the 50 lakh ceiling. But in the second example, the taxable income is not, but the gross receipt, yes. So in this situation, will 44 ADA or 44 AB audit apply in the case of such a profession?
Yes, sir. The same law analogy apply.
Yeah. Now what our institute in the guidance note, they went on to say that any exempt income need not be considered for the purpose of gross receipt or turnover. So that is a analogy that one can take to say that this gross receipt does not include exempt income of 20 lakhs. Since your taxable income is only 32 lakhs and gross receipt itself is 32 lakhs, you don't have to do the audit of such a firm. So since I was on 44 AD, I'll just tell you the differences between 44 AD and the similarities between 44 AD and ADA. One of the important thing is 44 AD applies to whom? Applies to an eligible assessee. It uses the word eligible assessee. Who is an eligible assessee? Individual, HUF, and a partnership firm not being an LLP. Not being an LLP. 44 ADA, the specified professionals, is applicable to whom, sir? Very interestingly, until 1920, it was applicable to any assessee, any person. It used the word any person. But from this year onwards, it went on to say, it is the Finance Act 2021 with retrospective effect, it went on to say that 44 ADA is applicable only to an individual, a partnership firm not being an LLP. Partnership firm not being an LLP. Interestingly, in the Finance Act 2021, they went on to say any person will remove, because we were saying 44 ADA means any person means even an LLP could come under 44 ADA. Now they have blocked it. Why did they block for LLP? Because for income tax firms include LLP. Firm includes LLP, but for only 44 AD they had made an exception. Now they made an exception in ADA also from this year. What is the reason? Because LLP Act wants me to maintain books of accounts. So you cannot go beyond the LLP Act. One act saying don't maintain books of accounts, another act. So they said LLP. Now, can a company be a specified professional? Can a company be a specified professional? Husband and wife doctors, they set up a private limited company. Can we say that the company is a specified professional? The answer is no. Extending the same logic, can a partnership firm consisting of husband and wife, or for that matter, me and Pankaj Bhai coming as chartered accountants and starting a partnership firm, is the firm a professional firm?
Yes.
The answer is yes, because Partnership Act says the partners and the firm are one and the same. Income Tax Act treats partnership firm as something different from that's a different issue. But in short, a partnership firm can be a specified professional, whereas in the case of a company, it cannot be a specified professional. Now, can a HUF be a specified professional? husband, wife, and son, all three chartered accountants, they have individual practice and a HUF practice. Can they have a HUF practice? Not digestible. Not digestible. Very interestingly, Pankaj Bhai, in the finance bill, if you open up Finance Act 2021, they said 44 ADA, instead of any person, we will make it applicable to individual, HUF, partnership firm, not being an LLP. And then when the act was passed, they dropped the word HUF. Because I had marked that, how can HUF be a specified professional? So today, 44 ADA, AD business applies through to individuals, HUF, and partnership firm not being LLP, but ADA applies only to two, which is partnership firm not being LLP and individual. So that is the first point to be noted. And the second difference between AD and ADA is here it is up to 2 crores and here it is up to 50 lakhs. The third difference is here it is minimum 8%, minimum 8%. Now I'm stressing on the word minimum 8% or such other higher amount. Here it is minimum 50%. In 44 AD, we have an exception of 6%, 2% reduction. There is no such reduction in the case of ADA. That means whether or not you get in check or cash, it is 50%. And the very interesting similar difference, which we already said, is 44 AD is an option. Once which is opted, you continue under 44 AD for 5 years. But in the case of 44 ADA, there is no such option. So these are all the differences between AD and ADA. Let's now talk about similarities between the two. Let's talk about the similarities between the two. Provisions of section 28 to 43C will not be applicable for both of them. That means if you are coming under 44 AD or ADA, suppose some payment is given in cash, more than 10,000 rupees. Will it be subject to 48(3) disallowance? Some item, will it be subject to 48(3) disallowance? Reddy Garu, will it be subject to 48(3) disallowance? The answer is no, because 28 to 43C is not applicable to me. Similarly, if I did not make a TDS on a particular expenditure, will the provisions of TDS apply to me? Now I was very, very careful in framing my question. Will the provisions of TDS apply to me?
Yes. But the disallowance is not applicable.
Now there are, if you don't do TDS, sir, there are two violations. One violation of 40A1A. I mean 40A1A disallows me that 30% of that particular expenditure, and section 201. Section 201 treats me as an assessee in default. Now that gets me. So if I have not done a TDS, being an individual, being a proprietorship concern, when is TDS applicable to me? When is TDS applicable to me? Pankaj Bhai, you are muted.
Yeah, when I'm subjected to tax audit, no, an individual.
Individual, when you are subject to tax audit. When are you subject to tax audit in the case of an individual, sir?
Turnover exceeding.
No, there are so many turnovers. There are 1 crore, 5 crore, 10 crore, 2 crore, 50 lakhs. So ये जो सिर पड़ जाता है. So therefore, last year itself, they amended all the provisions for individuals to say a proprietorship concern. In the case of a proprietorship concern, TDS will be applicable if your turnover is more than 1 crore. And if in the case of a professional, more than 50 lakhs. So that this confusion of 2 crores, 10 crores, 5 crores, all of them are gone. So it is only 1 crore and 50 lakhs. So that means in the case of a proprietor, if his turnover is 1.5 crores, I'm just giving an example. If his turnover is 1.5 crores and he offers 8% profit, no problem. But on a fee of 10 lakhs, he should have made TDS. He has not done TDS. So he has not done TDS. 40A1A disallowance will not be applicable to him. But 2011, he will be considered as an assessee in default for not making the TDS under section 201. So this is what I wanted to say. Similarly, now let's come back to 44 AD or ADA. If it were to be a partnership firm, 40A3 disallowance will not happen, but 40A1A disallowance also will not happen. But TDS provisions in the case of a partnership firm, or I mean, that particular thing of even for HUF, it is the same thing. Individuals and HUF, more than 1 crore and more than 50 lakhs only, it will apply. But for partnership firm, there is no such relaxation. They should do TDS as long as they breach the limits told under the respective sections. So that is a point to be noted. All deductions under section 30 to 38 are deemed to be allowed, including 32. Very important point to be noted. Should we maintain books of accounts in the case of a 44 AD? I mean, I would say, sir, I would say that if you are a serious businessman, you maintain books of accounts. You may say to the income tax department that I have not maintained. Today, you know, in the income tax return, you are supposed to fill up so many informations: stocks, cash balance, debtors, creditors. I mean, if I did not maintain books of accounts, how will I know all those things? Means income tax department ko itna to akal hai ki if you are doing business, you know who your debtors are, who your creditors are, what your cash balance is. You cannot say I will keep everything in my mind and do business. I mean, therefore, you will, I mean, I would say maintain books of accounts. You don't have to show it to the department. That's a different issue. But then it is important for you to maintain books of accounts, because subsequent year, when you are coming in for tax, when you are growing, that becomes the opening balance and it continues in that sense. Having said that, depreciation. If I bought an asset for 10 crore, I mean, whatever, 50 lakh rupees, and I cannot say from the first year when I'm doing the audit, 50 lakhs ka upar depreciation lunga. That depreciation under section 32 is deemed to be allowed, in that 8%, in that 92% of expenditure as a businessman. So that carry forward of the value will be the value for the subsequent years. Now, between the two, a very important similarity is that the interest on the partner's capital and the remuneration is deemed to be within that 92% or within that 50% expenditure which is allowed. An exception to this rule is 44AE, sir. What is 44AE? 44AE is in the case of transporters owning less than 10 goods vehicle. Less than 10 goods vehicle. In 44AE, after showing that whatever 7,500 and 1,000 rupees per ton per truck, per ton, if it is more than 14 tons or 12 tons, whatever it is. So that particular thing, if you compute, you can, after computing the presumptive profit, claim the interest on capital and partners remuneration. 44AE is a exception. Now, a very good similarity between 44AD and ADA is, in both the cases, you need to pay advance tax only once, that is by 15th of March. That is on 15th of March. Yes, sir. Any questions on 44AD and ADA? And AB also.
Last में question है देखो. If my turnover is below 1 crore, can I claim loss of 10 lakhs without getting the tax audit?
Sure. As long as you did not go under 44AD in the past. If you did not go under 44AD in the past, so that's what it says. 44AD is one route, 44AA is one route. So if you went under 44AD, you know, once you have come under 8%, next year it was a 10 lakhs loss, then you have to get yourself audited. However, if you did not opt for 44AD in the beginning, then even if it is 10 lakh loss, you need not file the tax audit report and you can get going.
Artists, vocations, photographers, etc. will not come under profession, since no technical qualification is required to carry on their activity. Can their activities be treated as business transactions?
Definitely, yes. See, we have only one thing. How I'm answering this particular question is 44AD and 44ADA. ADA is limited to a few specified professionals. Whereas 44AD, although it uses the word income from business, 44AD subsection 6, when Deepak Bhai, if you have this thing, you can open it and see. It says it is not applicable. It is not applicable to a person covered under 44ADA. That means 44AD excludes only 44ADA professionals. That means all other professionals are covered under 44AD. It also excludes brokers, commission, persons earning commission income and agency business. In fact, I always keep telling five type of people cannot come under 44 AD, that is presumptive taxes. One is a person who is covered under 44 ADA. What do you mean by a person covered under 44 ADA? Let me expand. I will tell you a doctor. A doctor is a person covered under 44 ADA, and he has got, let us say, he has got 30 lakhs of professional income, and he has got about 80 lakhs of pharmacy sales. He has got 80 lakhs of pharmacy sales. Now he comes to me and says, for this 30 lakhs, I will show 50% under 44 ADA. And for this 80 lakhs, I will show 8% under 44 AD. Under 44 AD. Can he come under this particular scheme? Can I work out a scheme for him like this? Reddy Garu, am I clear? So a doctor having a professional income of 30 lakhs, he says my specified professional income is less than 50. I'm a specified professional. So 15 lakhs I will offer for tax. And I'm also running a pharmacy business of 80 lakhs. So on that 80 lakhs, I would like to offer 8%. Can I do that? Looked at independently, yes. Looked at independently, yes. Now you open up 44 AD clause 6. 44 AD clause 6 says, this section, this provision of 44 AD does not apply to a person covered under 44 ADA. That means the moment the person is a specified professional doctor, 44 AD does not apply to that person. Now, that means for this particular pharmacy business of 80 lakhs, he cannot come under 44 AD. He cannot come under 44 AD. Can he come under 44 AB because his income from business is less than 1 crore? The answer is yes. The answer is yes. He can come under 44 AB, get his, maintain books of accounts and show his real profits. And for this 30 lakhs of 44 ADA, he can come under specified profession. That is and so it is not applicable to a person covered under 44 AD. A person who has income from agency, commission or brokerage. And it is also not applicable to a person covered under 44 AE. So all these 5 people are excluded under 44 AD. Yes, sir. Any more questions?
There are a lot of questions on tax audit for intraday share market transactions and loss.
Yes, sir. Sir, very, very clear. The provisions of the Income Tax Act itself says anything which is speculation. Maybe you have to understand what is speculation before we get into that. Speculation is an item which is separately to be dealt with. It cannot be clubbed with my regular business income. It cannot be clubbed with my regular business income. Now, the question that comes out is whether the derivatives, whether the derivatives that I do in the stock market is actually a speculation. When I'm doing a indexed based, I don't take a delivery. Normally, what is speculation means that which is booked and you don't take a delivery and only exchange the price and square off. That is speculation. However, speculation has also been defined for the purpose of income tax as excluding those transactions which are happening through the recognized stock exchange. Through the recognized stock exchange. So that answers our first question to say that in the case of speculation, which is in the form of a derivative, which may look like a speculation for all purposes, but if it is done through a recognized stock exchange, even though I don't take the delivery, it will be considered as a regular business income, which can be offset against my business. If I incur a loss from derivative trading, I can set it off against my regular business. That is the first point. The second point is on intraday square off. Unfortunately, intraday square off is not considered as a derivative. It is a speculation. Intraday transactions are considered to be speculation. The third question that comes on speculation is to say that how do you compute turnovers? How do you compute turnover? The answer has been given by our guidance note on tax audit. Our guidance note on tax audit says how you compute your turnover. Now today I will say I want to buy 1 crore worth of Infosys shares. I mean, shares I will ask my broker going for derivative of 1 crore, whatever is the price. In fact, I don't want the shares of Infosys. I will only say today, whatever is the value, I will buy that much. And after 1 month, we'll square off. After 1 month, if the shares have gone up to 1 crore and 20 lakhs, 1 crore and 20 lakhs, I will say you give me 20 lakhs. For which I would have given him a commission of 2 lakhs or whatever that underlying cost I don't want to get into. So I have got 20 lakhs from my the other side. Now, this is on transaction 1. In transaction 2, I wanted to buy Wipro shares at, let us say, 2 crores. And then finally the prices fell and it became 1 crore and 50 lakhs. So I had to give 50 lakhs to the other person. So in transaction 1, I made 20 lakhs profit. In transaction 2, I made a 50 lakhs loss. Together, I made a loss of 30 lakhs, strictly speaking. Together, I made a loss of 30 lakhs. But our institute says you will have to combine these two numbers, ignoring the signs. So 20 and 50, if you combine, it becomes 70 lakhs. So turnover for the purpose of tax audit determination is 70 lakhs from to find out what is the cutoff. Now, can I in such a situation come under 44 AD? In the case of 44, that 70 lakhs, can I apply for 70 lakhs 8% and come out? The answer is yes. The answer is yes. If you want to prove that you have a loss of 30 lakhs, you have to maintain books of accounts. I don't want to maintain my books of accounts. I will just come under 8% of 70 lakhs and get going. The answer is fine. No problem. Yes. Any more questions?
Sir, I have one question here.
Yeah.
In the same margin case and all.
Yeah.
For determining the tax audit,
yeah.
the turnover is defined as sum of positive and negative margins.
It is as told in the guidance note, sir.
In the guidance note, sir. Yeah, in the guidance note.
Yeah.
But when I actually do the tax audit, what should be my turnover? Should it be the turnover should be the total value of sales, or my turnover should be 70 lakhs?
Sir, it has to be the accounting turnover.
Exactly. Yes.
It has to be accounting turnover.
Sir, yes.
So for the books of accounts, you cannot ignore signs.
Exactly. Yeah. So when I give the P&L account,
yes,
I should say that 1.5 crores or 2 crores, whatever
it will be 20 lakhs debit and 20 lakhs credit and 50 lakhs debit. 20 lakhs debit credit because that is my credit which I have got, and 50 lakhs of debit because that is the thing that I have paid. So 20 will be on the right side of my profit and loss account, 50 will be on the left side of my profit and loss account. That is why I will get a 30 lakhs loss. I mean, I cannot, how the hell, otherwise I'll have to go and read again CA all the way, how to make that minus plus 20 minus 50 as plus 70. I mean, there is no way that it can happen for accounting purpose like that.
And as intraday is a speculative, this
yes,
loss
sir.
cannot be set off with derivative profit, which are futures and options.
Just check up, sir. Just check up from the stock exchange. Section 43, subsection 5, very clearly goes on to say what is speculation and what is not speculation. So what it is told is derivatives done through a recognized stock exchange, whether it is securities or goods, is not. Even if you're dealing with gold derivatives or any rice derivative or wheat derivative, whatever derivative it is not. But intraday is unfortunately considered to be a speculative.
Both shares and goods. Intraday of a shares will be treated as a capital gains, or intraday of shares.
You tell me whether it is considered as a derivative. You have actually booked, sir. You have actually booked for Infosys shares. And in that day, you cleared off. It is not a derivative in that sense. If yes, you are dealing with, let us say, the index price or some price ka upar hi aap note nikalenge na, then it becomes a derivative. When you are dealing in the same stock and say that without squaring off, you give me the money for the differential, then it becomes an intraday. So that is not considered to be, that is considered to be speculative, not offsettable against your regular business income. And speculation, you know, has a limitation of 4 years, as against 8 years normally. Yes, sir. Any more questions?
Can the hospitals and nursing homes opt 44 AD, or should they come under 44 ADA?
Very good question, sir. First of all, we have to decide whether the nursing home is run by one doctor or as a partnership firm. If it is run by one doctor, I don't have a problem. Okay. The point that is coming is, in the case of one doctor, he wants to call it as the moment it is a nursing home, I want to call it as a business and not as a profession. I want to call it as a nursing home because I'm giving I'm collecting room rent, I'm doing all those stuff. Unfortunately, how our institute has taken it is, if it is a nursing home run by only doctors, whether as a proprietor or as a partnership firm, it is considered as a specified profession. However, if it is along with a non-professional, then it will be considered as a business. This is how our institute has opined in one of the issues to guidance notebook. So therefore, we say if the husband and wife of or doctors get somebody, one brother of the doctor who is not a doctor, bring him as a partner, and then call that as that firm as a, then you can claim it as a business.
Srinath ji asked, will the tax audit be applicable SSC wise or business wise?
Yeah, that's a very good question. Very interestingly, it is business wise and not SSC wise. It is business wise, which means if let us say Reddy Garu is having a commercial, let me use the other very strange example. He is doing a real estate business. And in that particular year, he has bought and sold about 4 sites costing 10 lakh rupees each. I mean, 4 sites of 10 lakh rupees each, he has bought and sold it for 60 lakhs. So thereby making a profit of 20 lakhs. This is as far as real estate is concerned. He was also dealing in cement. And there he had done a turnover of about 80 lakhs. Then he had also done a garment business of 4 crores. So we have 4 crores from garments, 80 lakhs from cement business, and 60 lakhs from real estate. Do I combine all of them and say for all the three, and for all the 3 he is maintaining separate books of accounts? Should I do the tax audit if I'm appointed as a tax auditor for all the 3? Or can I say I'm doing the audit of only the garment business and not that of these 2? The answer is very interesting, sir. I can do the audit of only garment business. And in that business, I can include the profit, if at all Mr. Reddy wants to show, for 80 lakhs under 44 AD and for 60 lakhs by maintaining books of accounts. He can do all these combinations when I am doing it. The answer is visible in the tax audit. I don't remember the clause number. One of the clauses goes on to say, let me recollect through the session, that one of the clauses, are there any items which are subject to presumptive taxes which are covered under the P&L account which you are doing the audit? So that clause is also told. So in short, the answer to that is, it is business wise and not SSC wise. Yeah, clause number 12. Clause number 12 of Form 3CD goes on to say whether the profit or loss includes any profits and gains assessable on presumptive basis. If yes, indicate the amount in the relevant section. And that is how one has to garner that. And this has the support of our guidance note also. Our institute's guidance note also talks in this particular, because it is in the case of an eligible business of an eligible assessee. Eligible assessee has been told who. Then for every eligible assessee, you'll have to work out 44 AD separate. Yes, sir. Next. Any more questions, or shall I go to the changes in tax audit report?
We'll just continue with that and come back for the questions after the questions. Sir, you want a break of 4 or 5 minutes because you have been talking.
I don't need, sir.
Thank you.
I mean, if you people need, then I'll take.
No. Don't do it.
So clause 44 AD. Clause 44 AD Form 3CD. Let us now try to understand when we use Form 3CA and when we use 3CB. Very simple, although just a refresh. 3CA means where audit is already done on the financial statements and you are only now doing the tax audit, then you are referring to the audit which is done under that particular act and recollecting that and saying the financial statements are attached and the details which are called for in Form 3CD are provided in Form 3CD, which is true and correct. So it has got only 3 clauses. Form 3C has got only 3 clauses. Form 3CB has got 5 clauses. When do I use Form 3CB? If I am doing the audit of the financial statements for the first time, then I will use Form 3CB. Normally, we use Form 3CB in the case of a proprietorship concern or a partnership firm, okay, where audit is not done under any other act. However, in the case of a company, I do the audit under form. I would have already done under the Companies Act. 143 wants me to do an audit. I have already done. Or a cooperative society audit is done. In the case of an LLP, it is slightly critical. I mean, it becomes dicey. Should I do audit in the case of an LLP for every LLP? The LLP Act says you do the audit of LLP if its turnover is more than 40 lakhs, if its contribution is more than 25 lakhs, or in the agreement, the partners have decided in any case they will get it audited if there is a clause. So in these 3 situations, you will get the books of accounts of the LLP audited, and in that context, you will prepare it under Form 3CA. So wherever audit is already done on the financial statements and a separate report is given, you will, and the issues with respect to accounting standards, the issues with respect to non-compliance of accounting standards, issue with respect to true and fairness of the financial statements is already covered in the audit report given under the respective statute. You use Form 3CA. Form 3CB is where the audit is done for the first time for the purpose of income tax, and also the audit of the financial statement is done for the first time. You use Form 3CB. 3CB has got, interestingly, 5 clauses as against 3 clauses in 3CA. This 5 clauses, first 3 clauses deal with financial statements. I mean, I will say that I have audited the financial statements. Please understand, in 3CA, audit on the financial statement could have been done by one person and audit on tax audit will be done by another person, or it could be done by the same person. But in 3CB, the financial statements are audited now only by the tax auditor. So first point, second point refers to, first point refers to, I am doing the audit of so and so, I'll refer to the firm and the entity. Second point, I will say the financial statements are true and fair. You know, I'm referring to the financial statement. Third point goes on to say, the observation with respect to financial statements are given below. That means if there are any qualifications on the financial statements, that qualification which would otherwise be given in the main audit report in the case of 3CA, when I use the 3CA, will now be given under clause 3 of Form 3CB. Clause 4 says whatever required information is given in 3CD, and such information given in 3CD are true and correct, subject to the following observations. So clause 5 of 3CB is equivalent to clause 3 of Form 3CA. So this is the fundamental understanding between 3CA and 3CB. Having said that, 3CD has got 44 clauses. All of us are aware, 3CD has got about 44 clauses. Two clauses, one dealing with GAR, and the other dealing with the reconciliation of GST. Clause number 44 dealing with reconciliation has been kept in abeyance. Clause 30C dealing with GAR and clause 44 dealing with GST reconciliation has been in abeyance since inception. Every year they are giving extension. This year also, for financial year 2021, also they have given a relaxation. So these clause number 30C and clause 44 need not be filled by the auditor. Now, having said that, on 1st of April 2021, they amended the Form 3CD. They amended the Form 3CD to make about 5 changes. Before that, they made a change in Rule 6G. What is Rule 6G? Rule 6G goes on to say which form has to be selected in which context. But in Rule 6G bracket 3, they inserted to say that they provided for revising the tax audit report. They built in a provision to revise the tax audit report. Why? What is the reason? They said for recalculating the disallowance under section 40 or 43B, if there is a payment after furnishing the original report, which necessitates the recalculation of disallowance under 40 or 43B. Now, let me explain what it means. It means all of us are aware. What are the due dates for filing the tax audit report, sir? The extended due dates. Let us now talk about the extended due dates for this year. I think
30th October.
30th October. I mean, we have this funny situation. September for non-audit cases.
Yes.
October for audit cases, audit report.
Yes.
November
Filing.
income tax return of audit cases.
Audit cases.
Now, since I am talking about the due date, let me warn everybody. Which is the one which you are going to do now? I mean, that is what we were discussing before the session. Deepak, Reddy Garu, Satish and Rajambal. We were discussing what should I do now? Should I do non-audit cases or should I do company audit cases? Because that is the, now under the Companies Act, the last date to conduct the AGM is 30th September. Last date to conduct the AGM is 30th September. Earlier, we had the situation of, pre-UDIN era, we could manage. But with the UDIN, I cannot go beyond 15 days now. And AGM, if I am conducting by 30th of September, then the UDIN maximum I can go. I mean, if at all I have to backdate it, it still can be up to maybe 14th October or 15th October, provided I take 95% of my shareholders' cognizance for shorter duration of notice period. If it is a proper notice period, then I would say 5th September is a cutoff. Cutoff has already happened.
Yes.
So my primary job is to ensure that I complete all my company audits at the earliest, especially because of UDIN. I mean, Mahesh says that recommend a UDIN extension for 2021. I think that we should keep it as a last resort. We should use this to push all our clients to ensure that they come and finish it off. I mean, that is how I would put it. Let us finish off company audit first as early as possible. And of course, the small assessees will also come. For them, for us, they may be small assessees, but for himself, he is the greatest assessee for himself. I mean, we cannot say you are a small assessee. And he says, sir, once in a year, I come to you to see you. And therefore, I have to give him all the hearing, patient hearing, although his filing fee may only be a few thousand rupees. And I have that's a big dilemma that we have to face. I wish that, I want to tell the finance minister, please give for all these small cases up to March time. We would finish off all the large cases at the beginning and small cases can happen at leisure. Now, having said that, the due date is one thing, but what did they say is after filing your tax audit report, within 1 month, you have to file the income tax return. What is this reason? Why is it told like that? Again, I was talking of 26AS and intelligent, the pre-filling of the income tax return. The income tax department wants to say the income tax return will be pre-filled. What is the basis for filling this income tax return? The bank has told what is the interest, what is the TDS. So this interest income will come and sit in my income tax return. Dividend income will come and sit in my income tax return. My GST turnover will go and sit in my profit and loss account prepared by the income tax department. This is your GST turnover. And very interestingly, the information which I fed in my 3CD will go and sit as respective disallowances or allowances in the income tax return. So if I file my TDS, tax audit report in the month of October, within November, within 1 month time, all this information will flow and sit in the income tax return. So that is the genesis or the objective with which they are given a time gap between tax audit report and income tax return. Having said that, now we have one other provision, 40A1A, 43B. Disallowances have to be reported in Form 3CD. If it is not paid by 30th October, I will report it. If he tells that I will pay in the month of November, can I say that he has promised to pay in the month of November, therefore allow? Can I go by his promise? No, I cannot. I will say until date he has not paid. So it has to be disallowed. But legally, he is entitled to claim 40A1A and 43B till the due date of filing his income tax return. Now, what after I show it as a disallowance in my tax audit report, he actually pays. So there was we could have anyway revised it, but now rule 6G bracket 3, clause 3 has got inserted to say you can revise whatever tax audit report you have filed, you can revise to accommodate the disallowances or allowances with respect to 40 and 43B. 40 means 40A1A or 40A1 and 43B. Are we clear, sir? Now let me tell you one more thing. This particular revision is not only for 40 or 43B. Earlier itself, our institute in the guidance note had told that if there is any mistake which you observe later on, you observe a mistake later on, having furnished the tax audit report, you must revise your tax audit report. Can we revise it? The answer is yes. Now, the department has anyway told for these reasons also you can revise. So that is the first point to be noted. So that is a change which happened from 1st of April 2021. Then they brought in 5 changes in Form 3CD. Clause 8. You know what is Clause 8 dealing with? Indicate the relevant clause of section 44AB under which the audit has been conducted. That is a clause. They inserted a clause 8A. Clause 8A. Last year only they inserted. They inserted clause 8A where they said whether the assessee has opted for 115 BAA, BAB. Last year itna aaya tha. Now they brought in 115 BAB and BAD. BAC and BAD. So what is 115 BAC, sir? What is 115 BAC?
Deduction for manufacturing company.
115 BAC is that popular option given to individuals and HUFs.
Sorry.
Either to go for
new regime and
we call it as the new option. New option is what Kiran Kumar said. Where they said normally, let me now talk about 115 BAC. This clause is only ticking whether the assessee has opted for 115 BAC or BAD. BAA and BAB, if he has opted last year, it is fine. Otherwise, you would not have ticked last year. This year, he did not opt last year. He can opt 115 BAA or BAB this year also. If he has opted, then it is only for companies. BAC is for individuals and HUF. BAD is for cooperative societies. Now, what is BAC? Let us, for a moment, spend some time on BAC. 115 BAC, you have an individual or HUF can either go in for normal scheme of 0 to 2.5 nil, 2.5 to 5%, 5 to 10, 20%, more than 10, 30%. This is a normal scheme and claim all eligible exemptions and deductions. This is the normal scheme. Now, if you want to go in for the new regime, you have a beneficial provision 0 to 2.5 nil, 2.5 to 5%. Then thereafter, for every 2.5 lakhs, there is an incremental slab with only 5% increase. So 5 to 7.5, in the normal scheme, it is 20%. In this scheme, it will be 10%. 7.5 to 10, normal scheme, it is 20%. In this scheme, it will be 15%. So from 10 to 12.5, 20%. From 12.5 to 15, it is 25. After 15, it will be 30. In this case, in the normal scheme, after 10 itself, it will be 30. So in short, if you go in for the new scheme, you will be paying lesser tax. But the disadvantage with the new scheme is you will have to give a lot of exemptions and deductions. What are the exemptions and deductions that has to be given up? If he is a salaried employee, he cannot claim the LTA. He cannot claim HRA. He cannot even claim standard deduction. So this is as far as the salaried employee is concerned. If you happen to be a businessman, you cannot claim additional depreciation on new plant and machinery. And in the case of all assessees, the minor children, what your income gets clubbed, you will get 1,500 rupees into 2. That also cannot be claimed. Interest on self-occupied property under section 24B cannot be claimed. All section 80, all section chapter 6A deductions cannot be claimed, excepting 80JJAA. 80JJAA. So this is the scheme how it operates. Yesterday, one of the senior chartered accountants called me up and asked one question. Can the benefit of senior citizens be given if you are opting for the new scheme?
Yes.
The answer is no, sir. Because that 2.5 to 5 lakhs ka jo 5% hai, if you come under this scheme, you don't get the benefit of senior citizens. That means up to 3 lakhs and 5 lakhs, senior citizen, very senior citizens, you have this 3 lakhs and 5 lakhs, no?
But rebate is there, no, sir. Rebate, see.
No. Rebate is there only if your income is up to 5 lakhs.
Yes. So
if it is up to 5 lakhs, both the schemes does not make
are
any
same.
difference.
Yeah.
It does not make any difference. You rather, I would say, don't opt.
Yes.
Go under the regular scheme itself.
Old scheme.
But if you are a senior citizen or a very senior citizen and you opt for 115 BAC, can you get the benefit of up to 5 lakhs no tax? The answer is no, because 115 BAC says, notwithstanding anything told anywhere else, the following are the rates. If you open up 115 BAC, it says 0 to 2.5, nil, 2.5 to 5%. So even for a very senior citizen, he has to pay for 2.5 lakhs to 5 lakhs, 5%. Looks like Pankaj bhai, you're not convinced?
Slightly, I'm a bit confused because
No,
everywhere up to 5 lakhs, they said the tax should be same, and 87A is a post-tax thing. No, sir. It's a rebate.
No,
so
sir.
all the benefits have been removed.
No, let me tell you. This particular rebate, what you're talking, is available only if your income is within 5 lakhs. Let us, I always give this example. What if your income is 5 lakh and 1,000 rupees? 5 lakh and 1,000 rupees.
13,000 plus is the tax.
12,500, I think. 12,500.
12,500 plus 4% cess. Yeah. Okay.
4% cess छोड़ दो. मैं 1,000 rupees का ऊपर बात कर रहा हूँ. 1,000 rupees का ऊपर you will be paying another 20%. I'm talking of the regular scheme, which is 200. So 12,700 rupees you will pay. I mean, I always used to say this jokingly. To save this 12,700, you make a donation of 1,500 rupees. What happens, sir, by donating 1,500, your total income will come down to less than 5 lakhs. 2,000, I think. Yeah. No, you, whatever. 2,000 karo, jo bhi karo. So then it comes below 5 lakhs, and then you don't have to pay this 12,500 rupees tax. Now, having said that, we are not talking of such a situation. We are talking about a very senior citizen having an income of 12 lakh rupees. Can he come under rebate? The answer is no. Can he get the benefit of up to 5 lakhs? He does not have to pay tax. If you come under the regular tax, up to 3 lakhs, that benefit is there for senior citizens and very senior citizens. That benefit is there in the Finance Act. Section 2 of the Finance Act tells you what is the normal rate. If you want to go under Section 2 of the Finance Act, the normal rate, then you are entitled to get all the benefit of senior citizens. Once you come under 115 BAC, you are coming under 0 to 2.5, nil, 2.5 to 5%, even for very senior citizens. That's what I wanted to say. The next question that keeps coming is, which scheme is better? I mean, normally the clients will come and say, sir, new scheme is there, which scheme is better? Now I will say, we work out both the schemes. Whichever scheme gives you a lower tax, that scheme is better.
2.5 lakhs is the criteria, sir. If your deductions can add up to 2.5 lakhs, more than that, blindly old scheme, less than that, new scheme may be better.
Correct. Now, also, let me tell you the next question. Can I opt for 115 BAC this year and opt out next year?
Salaried, yes.
That what they told is, if you do not, they have made two types of assessees. Assessees having business income, assessees not having business income. If the assessee does not have business income, he can toggle between normal and optional every year. But before you file your income tax return, you have to file one form 10IE. You have to file that particular form. Although there was a tweet from the department saying that you don't have to file, but there is no order coming in that sense. Yes, Pankaj bhai.
In fact, yes, I agree with you, sir. Though they said that form 10IE, But the problem is there that Form 10IE only talks about income from profession. It is only asking income from profession. And now I think they have withdrawn for salaried employees. Only for business, they are insisting for 10IE.
It looks like, but there is no order to that effect. They said that the person has to file a form as may be notified before filing the income tax return. That is what is still there in the rules. So I don't want to officially say that you don't have to file the form. But because of the theory of impossibility, that means they have not released the form. Then I have to file my income tax return before the due date means, then I can get the relief accordingly. There has been a tweet also from the department, but I don't give my opinions based on tweet. I mean, it has to be based on the notifications or circulars. In that sense,
they release the form, sir. The form is there. Okay. The form asks your name and all, and ask how much is income from your business and profession. Okay. So that's where for a salaried employee, it's nil. No, that is a problem.
I think that is how the tweet said. For other than salaried person, I mean, they say other than business income, Form 10IE need not be filed is what the tweet said.
Yes.
Now, having said that, let's now talk about 115 BAC for a businessman. A businessman, once he opts for 115 BAC, must continue under 115 BAC forever. However, if he wants, he can come out of that once to normal scheme, and thereafter he can never go into the optional scheme as long as he has got business income. That means he can go back to the option once he gives up, he does not have business income, means then he becomes a other than a business case. Yes, sir. Any questions on 115 BAC, BAB? Otherwise, we'll proceed.
Yeah. 1 second, sir, because same thing.
Or any other interesting question also you can take.
1 second. So most of the questions are coming in chat. I have one request to all the participants. Answer to Gurraj sir, we can put it in chat. And the question to be asked, if you put it in Q&A, then we don't have to shuffle between here or there. It will be easy for us to ask the questions, because most of the questions are coming because Swami Venkat says it's necessary to file Form 10IE in case of salaried person, which we answered. And then there is a chat going on between filed and not filed. See what I've, sir, as on date, it seems 10E is mandatory as it's picking the same in ITR. I think most of them are relating to 10IE only, sir. We'll just come back to questions.
Yeah, 10IE, that issue remains. See, for the moment, forget about 10IE. ITR itself is an issue. You know, ITR itself, I'm told only ITR 1 and ITR 4 are being filed in our office. All other ITRs, we are not able to file. So let's hope that it gets resolved. Now, one more interesting thing about 115 BAC is that if you opt under this scheme, any of the losses that are otherwise not allowable in future, if you have brought forward, that will not be allowed. In short, the additional depreciation, if you have got additional depreciation, unabsorbed additional depreciation as a businessman, and now you decide to go in for the new scheme, then the unabsorbed additional depreciation cannot be claimed in future, but that unabsorbed depreciation, additional depreciation, can be added back to the opening return on value, and your future depreciation will get inflated to that extent. So that is a point to be noted. So to that extent, clause 32 and clause 18 have got amended. Clause 18 says, clause 18 to include details of adjustments to return on value. Well, let us say I had about 12 lakh rupees of unabsorbed additional depreciation last year. This 12 lakhs, and I had whatever 1 crore of return on value. To this 1 crore, I can add back 12 lakh rupees and claim on depreciation on 1 crore and 12 lakhs instead of claiming the 12 lakhs itself as a depreciation. However, if you feel that by claiming 12 lakh rupees, you are better off, then you might claim this depreciation this year without opting for the new scheme, go under the regular scheme, exhaust all your unabsorbed depreciation, and next year you can go to opt for the new scheme. So clause 18 is amended to that extent, clause 18 of the Form 3 CD. Similarly, clause 32 goes on to ask the auditor, are there any unabsorbed losses or unabsorbed depreciation which by virtue of his claiming this 115 BAC, he should not be entitled to claim. So in that column, I have to put that 12 lakh rupees he cannot claim, or any such unabsorbed losses which he has got. It could be by virtue of section 35 or so many other 35 AD. I mean, I'm not getting into the technicalities of this today. So there are so many provisions by virtue of which you could have had a loss. Those losses has to be surrendered for forever. But if you feel that you are better off claiming that loss, you better claim and go in for the new scheme next year. Two more clauses have got amended. One is a very interesting clause which has got amended. Let me talk about it. Clause 36, dealing with the dividend distribution tax, has got amended, abolished. What is the reason? The reason all of us are aware that from 2021 onwards, we have gone to the classical system of taxation, which is taxing the dividends in the hands of the receiver. Taxing the dividends in the hands of the receiver. Now, let us now talk about dividends. Now, when we are talking about dividends, you will now get taxed in your individual hands, and there are at least 2 or 3 provisions of dividends which we should be aware of. Sir, all of us are aware of section 14A, which says that income, if it is exempt, the expenditure on that will not be allowed. The expenditure on that will not be allowed. All these days, 14A was coming in the way of my claiming the expenditure in relation to earning dividend income in the way. I mean, I could not have claimed any expenditure. Now that dividend is getting taxed in my hands, can I claim the expenditure associated with incurring the dividend income? Satish, what is your view? I think
Yes.
Anand Verma, I mean, all the answers that are coming are saying yes. I'll give you an example. I have invested about 100 crores in shares, and this year I have received about 4 crores as dividends. 4 crores as dividend income. Now my question is, I have spent about 3 crores as 2.5 crores as interest, because to invest 100 crores I had borrowed some 30 crores and I have paid 3 crores as interest, and some 25 lakhs I am maintaining an office. I am maintaining an office to run this particular income, this particular investment division. Yes. Can I claim this 3 crore and 25 lakhs as an expenditure against 4 crores?
No, sir.
14A was coming in the way. Earlier 14A, because 4 crores was not taxed in my hands, 14A said if the income is exempt, dividend was exempt. So therefore expenditure was also not taxable. Now there, which is the section which says it is going to be taxed? Section 56, income from other sources, where our 56(2)(10) bigger brother is there. There only 56 is going to tell me that dividend income is going to be taxed. Section 57. Section 57 has now come in as a villain like section 14A earlier. Earlier the villain was 14A. Now the villain is section 57. You know what it says? Section 57 goes on to say your maximum expenditure that can be claimed against your income from dividend will be restricted to 20% of your dividend income, that too with respect to interest on loans taken for investments. In short, no other expenditure. I told you 25 lakhs I will incur for having the establishment. Gone, I cannot claim. Then I had incurred 3 crores as interest expenditure. He says actual or 20% of my dividend income, whichever is lower. We don't have to think. If it's a deduction, whichever is lower. If it is taxation means whichever is higher. So whichever is lower will be allowed as a expenditure. Are we clear, sir? So the maximum expenditure that I can claim is only 20% of my income. Point number 2, another point to be noted with respect to dividend income is, if my dividend income is now, let us say we are aware, in the case of Azim Premji, he might be getting about 200 crores dividend income and much more, I don't know. I'm just saying, if you are getting a dividend income of more than 5 crores, you know, as an individual, up to 50 lakhs, there is no surcharge. 50 lakhs to 1 crore, 10% surcharge, 1 to 2, 15% surcharge. 2 to 5, 25% surcharge, and more than 5 crores, there is a 37% surcharge, such that my MMR will be to the extent of 42.744%. That is my MMR. Now, if I am receiving only dividend income of 200 crores, only dividend income of 200 crores, that means my income is more than 5 crores. Will I still be subject to the, is there any benefit that is I am getting, or will I still have to pay a surcharge of 37%?
No, sir.
What is the maximum surcharge, sir?
So maximum surcharge is 37%, but for the calculation of 5 crore, the limit for surcharge, they have excluded the dividend received by the.
So what is the maximum surcharge that I have to pay on a dividend income? They have told 15%.
15%.
So that is told in the Finance Act itself. In the Finance Act itself, they have told that the maximum surcharge that I need to pay with respect to dividend income. Now, I told you an example where I have dividend income only, then it is easy. What if I have got dividend income and other than dividend income, regular business income? So on the regular business income, it can go up to 37%. But on this dividend income, I'll have to cull out from the total income, the dividend income, and restrict that surcharge to 15%. So this is a very interesting point to be noted. The third point to be noted is I receive dividends now, let us say in the month of September. In the month of September, I receive it. But do I have to pay the advance tax on such a dividend income in the month of July?
No.
Where did they tell that, sir? How are you saying no?
They have told in the relevant section for the advance tax installment, like the cutoff dates for the similarly to the capital gain, the date of the similar provision and benefit has been given to dividend also.
Yes, sir.
Right to receive is determined.
Yes. So what has happened is this particular provision of taxing dividends in the hands of the receiver came in the books of income tax last year. In Finance Act 2020, it came. Then a representation went to the Finance Ministry. In 2021 Finance Act, they gave a retrospective effect, saying that with effect from 1/4/2020 onwards, the dividends, if you receive, the shortfall of income tax which you pay, shortfall of advance tax which you pay on account of dividends will not be subject to 234C for the prior advance tax from which you have received. That means you will be liable to pay advance tax only from the subsequent quarters. This is told in section 234C. Section 234C, because of, and this has been told in Finance Act 21, having retrospective effect. Having retrospective effect to bring this within the income tax return, they have told dividends received in which quarter has to be filled. Because based on which quarter, the department will also recheck whether your 234C is properly calculated. As Deepak Bhai, you rightly said, this particular deferment of advance tax until receipt is available even for capital gains and for one more. What is that one more? Income which is income from a business which is newly established. Which is newly established. Otherwise, this came in, I think, 2013 or 2012. Until that date, very funnily, Pankaj Bhai, that although I started my business in the month of, let us say I incorporated a company in the month of January, the Income Tax Act said I should have paid before I was born. I mean, that is how it had told. Now that particular relaxation is given. So for all these three cases, dividends, capital gains, and income from a business which is newly set up. Now, one more change which has happened in clause form 3CD is with respect to clause 17. What does clause 17 deal with? Clause 17 deals with, all of us are aware of section 50C, section 43CA, and 56(2)(10). What is 50C, sir? I mean, I always take this example. If I am selling a land of 1 crore to Mr. Reddy for 70 lakhs, then 50C says the turnover for my purpose should be 1 crore. The turnover for my, I mean, the sales for the purpose of capital gains should be 1 crore. And in the case of Mr. Reddy, 30 lakhs will be taken as income under 56 to 10. This is as far as the seller, for the seller, if it is a capital asset. What if the seller is not a capital asset, but he is dealing in, that is a business income? Then it becomes a stock in trade. It is not a capital asset for which capital gains need not come into picture. So I used to escape out of 50C. So 4 or 5 years back, they introduced 43CA to say similar mutatis mutandis 50C, whatever applies, is also applicable to 43CA in the case of a businessman. That means, although my transaction value is 70 lakhs, the credit to my profit and loss account should be 1 crore. Now, whether credit to my profit and loss account should be 1 crore or credit to my profit and loss account will be only 70 lakhs, because that is my transaction value for accounting purpose, like what Pankaj Bhai said. But in my income tax return, I will have to add back 30 lakhs as deemed income under section 43CA, being the differential of the stamp duty value and the actual transaction value. Now look at this. We are aware of 50C, and for 43C also, Mr. Reddy will have to pay. Whether I am a capital seller or a business asset seller, for Mr. Reddy, for the receiver, 30 lakhs differential will have to be subject to tax under 56 to 10 only. Are we clear, sir? I mean, this provision is very clear. There are certain exceptions to this rule. Today, I am not talking about those exceptions. One of the interesting exception is, let me talk about one interesting exception, which is if we have entered into a transaction earlier, in earlier years, and we have exchanged consideration in permitted modes, account paid check, account paid draft, electronic clearance system, and 8 other permitted modes under rule 6ABBA. They have told 8 other permitted modes. That is debit card, credit card, NEFT, RTGS, BEAM, UPI, 8 other permitted modes. If I have already taken some advance from Mr. Reddy 4 years ago, when the guidance value was 70 lakhs, and we have already entered into an agreement. That agreement, they are not talking oral or written, is not told. Maybe I will convert it into a writing for the purpose of income tax. Even if it is backdated agreement, I may backdate, but I cannot backdate the check entries. So therefore, they said, if the transactions are done in permitted modes, then that year's guidance value will be the base. So in my example, let me say that 70 lakhs was the guidance value last 4 years ago when the consideration got exchanged. Then nothing under 50C, nothing under 43CA, nothing under 56 to 10. Clear? Now, there is one exception to this rule where they said we will give a permitted deviation up to 10%. There is a permitted deviation of up to 10% provided in all the three, in 50C, 43CA, and 56 to 10. They said up to 10% deviation is accepted. But the wording is not so simple. They did not say up to 10% of, they said the guidance value should be less than 110% of the actual transaction value. I mean, that is how they have told. How it tantamounts, for example, let me give you an example. If I am doing a transaction of 1 crore to Mr. Reddy, 10% means 90 lakhs. I mean, if I am taking it as 10 lakhs, if I have done a transaction with Mr. Reddy at 90 lakh rupees, I have sold the property at 90 lakhs to Mr. Reddy. Am I coming within the permitted mode? Yes or no? What is the cutoff? What is the cutoff? How do you determine the cutoff?
I will calculate 10% from the transaction base.
You know how you should calculate that 10%? It's very interesting. It is whatever is the guidance value divided by 110%. That will give you the correct picture. So guidance value is 1 crore divided by 110% means 91 point, I think it is 90.91. 90.91. So 90.91 means if I have sold the property at 91 lakh rupees to Mr. Reddy, then I am within the permitted mode. So no additions required under 50C or 56 to 10. If I sell it at 90 lakhs, please understand, if I sell it at 90 lakhs, then I will have to offer 1 crore as the sale value, and Mr. Reddy has to offer not this, the difference between 90.91 and 90. He has to offer the entire 10 lakh rupees under 56 to 10. Am I clear, sir? This deviation is also permitted for 43 CA. For 43 CA. Next, in the month under the Atmanirbhar scheme, because lot of properties were not getting sold, the inventories were held by the builders. They said for a limited period from 12th November 2020 to 30th June 2021. Mark these two dates, 12th November 20 to 30th June 2021. They said, in the case of a builder who is selling the assets, who is selling his assets, this deviation of 10% can go up to 20%. Provided the transaction value is less than 2 crores. So one, they put the condition for the timing. It's only between November 20 to June 21. Then they put the condition only between the 43 CA type cases. That means these item to be sold should be a business asset and not a capital asset. And point number 3 is they said it should be less than 2 crores. So this they brought in as a proviso to section 43 CA and a proviso to section 56(2)(10). Now, as a tax auditor, I have to comment in clause number 17, are there any values which are breaching, which I have to tell? So up to 10% normal, I don't have to say, but for these exception provisions, they have carved out a thing and said clause 17 to include details of transfer of land or building for consideration less than the value under 43 CA and whether such transfer falls under the 4th proviso to 56(2)(10) and the 2nd proviso to 43 CA. So that is what has to be told there. So these are the 5 changes in form number 3CD. Let me recap what are the 5 changes. Whether you have opted 115 BAC or BAD, yes or no, you have to tick. If you have opted, then making the adjustment in return on value with respect to the brought forward depreciation. Also, what are all the losses and unabsorbed depreciation you are not eligible to claim is also has to be told. Then dividend distribution tax has been abolished. And finally, clause 17 to talk about 43 CA and 56(2)(10) proviso has to be commented by the tax auditor. So these are the 5 changes which have happened with respect to form 3CD. Any questions on that? I am prepared to take.
Can section 50C and 56 be made an item to be verified for tax audit purpose?
Yes, clause 17 tells it, na? Clause 17 of, you want me to read out, you can keep the tax audit report. Clause 17, whether any land or building or both is transferred during the previous year for a consideration less than the value adopted or assessed or assessable by an authority of the state government referred to in 43C or 50C. Please furnish 1. Details of the property, consideration received or accrued, value adopted or assessed or assessable. Then he has introduced this year whether provision of 2nd proviso to 43CA 1 or 4th proviso to 56(2)(10) is applicable. Yes or no?
Can foreign travel expenditure be claimed against dividend from foreign company?
The dividend from foreign company is also taxed under section 56. Now, having said that, 57 restricts only the expenditure allowed for interest. No other expenditure can be claimed. No other expenditure can be claimed.
So derivatives and intraday businesses should be treated as short-term capital gain or losses.
So that depends on your, as far as speculation is concerned, I don't think it will come under capital gains at all. It is a sort of a business income. It is not thought about in this thing. As far as the derivative transaction is concerned, it goes by the period of holding. I mean, of course, you have not held it as a period. That's a very interesting question. Pankaj bhai, you have any answer for that? Derivatives, whether you will tax it under long term or short term? But in my opinion, because you are not holding that particular asset itself,
yes,
so
there is no delivery of the asset.
Yeah, from the date of delivery, so it's all short term only. Yes, sir. Any more questions, or shall we move to the next?
Please proceed, sir.
So at last, what I do is, now I'll put up my presentation. Okay. Most of the things I've already covered. What I have not covered is what I will now take it up. Because I was so energized looking at your faces that I thought I should not put up the, one of the interesting things about 43 CA, there is a good tax planning if anybody who is in real estate wants to do. I mean, I was talking about 1 crore property sold at 70 lakhs, not coming under 10%, 20%. I sold it at 70 and I did not enter into an agreement 4 years. So logically, I have to credit to my profit and loss account 1 crore. That is how it is. But what, I mean, in business, I can always give discounts. I can always give discount. Can I claim the 30 lakh rupees as a discount given to my customer? Or in the worst situation, can I claim it as a bad debt?
Yes.
This is a tax planning, I leave it to you. Well, possible, quite possible. I mean, if you say no means you're a good man, that's it. If you are saying yes means you're a businessman. Okay, that's how it is. So you're able to see the screen, sir?
Yeah, but can you make it slideshow?
Yeah, I made it. Is it now clear? Better? Yeah, we were supposed to talk about the change in the due dates, important notifications, Finance Act. Yeah, when we were talking about, now I will see whatever I have missed, I will talk. Of course, due dates we have already seen. So I don't want to talk about that. Interestingly, I think Rajambal was talking about, we were very serious filing all the trust returns, and now they have pushed it up to 31st of March 2022. But please be aware that if you are filing the trust return and your trust is actually registered both under 12A and under 80G, you need to file Form 10A twice. Once for registering the trust under 12AA or 12AB now, and again under 80G. So you'll have to file Form 10A twice using the relevant codes in item number 2. So that's a point to be noted. Although the dates have got extended, you take the benefit of that extension. 54G, I don't want to talk about. All the assessments have got pushed. And finally, for both assessment year 18-19 and 19-20, the due date for passing the 143.3 order is 30th of September. So we are sitting this month under the time barring while we are supposed to finalize the AGM dates and all those stuff. Inka bhi notice aaya to unko bhi face karna padega because they are due date. So that is another challenge. So the income tax returns, we have already seen, we don't have to really talk about it. Only one change which has happened is transfer pricing cases. Last year only they made a change with respect to partners of a partnership firm. Earlier it said that only working partner due date was aligned to the firm's due date. Last year they made it all partners aligned to the firm's due date. If the firm is subject to tax audit, then all the partners of such a firm also, their due dates will be equivalent to the firm's due date. This was missing in the case of a transfer pricing. In the case of transfer pricing, we know that the original due date is 30th November, extended up to 31st December. If that transfer pricing case happened to be a partnership firm, that was not told. Now, if the firm is subject to a TP study, then the partners of such firm also, the due date is equivalent to the due date of the firm which is subject to transfer pricing study. Belated returns, please be very careful. Belated returns this year in the Finance Act 2021, they have reduced the last date for filing the belated returns only by December. But for the COVID, December was the last date. Now they are saying that it is extended up to 31st of January 2022. If this were the original due dates were to be retained, all our assessments would have gotten over. All our returns have also gotten over. So January to March, all of us could have gone in for a honeymoon. But one interesting point to be noted, please note that although the due dates have got extended, the time limit for paying taxes, especially with respect to those cases where self-assessment tax is more than 1 lakh, you will have to pay it by the due date. Otherwise, 234A will apply from the original due dates. There has been no relaxation even with respect to interest payments. Last year, there was some slight relaxation with respect to interest payments. So income tax returns I will not touch. I will not get into the details of income tax return. Yes, 26 AS we have seen a lot of changes. Capital gains on listed securities, on transfer of listed securities and transfer of units of mutual funds will also now come in 26 AS by virtue of stock exchanges, depositories or the RTAs reporting such a matter to. They don't report the sale value because they know what is your cost. They have to compute the capital gains and tell whether it is long term or short term and report it to the CBD, report to the income tax portal, which will now come and happily sit in my 26 AS. Now, dividend income, whether or not the company is deducting TDS, all of us are aware that more than 5,000 rupees when the dividends are given, TDS has to be done. But even if TDS is not done and a dividend is given by a company, that means every dividend paying company, let us put it like that. There are 2 points we have to address as chartered accountants. If I am a dividend recipient, it will come and sit in my 26 AS. But if I am a dividend declaring company, then whether I am a private limited company, whether or not I have deducted TDS on that, that information has to be filed in Form 61 to the income tax department. Interest income by a bank, cooperative bank, post office or an NBFC. A lot of us may be advisors to NBFCs. NBFCs also have to report interest income on all interest, whether or not TDS is done, to the income tax department through the SFT portal. So that's a point to be noted, which will of course come and sit in my 26 AS. So 26 AS. Now, one very interesting thing about Pankaj bhai, the question that comes out is, if I'm an employer and my employee is admitted to the hospital and I'm paying him the hospital charges, is it exempt from tax? No, that was the question which came out. CBDT was silent, and on 25th of June 2021, they came out with a press release for which necessary notification amendments has to happen in the Act. So what they said is, amount received from an employer or any other person for treatment of COVID-19 during financial year 1920 and subsequent years will be totally exempt from tax. Am I clear, sir? It will be totally exempt from tax. It could be even if I as a patient have received it even from a non-employer. Now, if Pankaj bhai has given me, normally it will become 56,210. Why should you bear my expenditure? It becomes 56,210. If you give money to me. Otherwise, 56,210 does not come. Please understand, 56,210 is money, immovable property, or property as defined under 56,207. Hospital expenditure is not covered, so therefore I could have taken an exemption. That's a different subject. But having said that, this was clarified saying that hospital expenditure is totally exempt if it is borne either by the employer or by anybody else. But unfortunately, if such a person dies and his family is given an ex gratia, they said that if ex gratia is given by an employer to the family, then it is totally exempt from tax. But if it is given by any other person, it is exempt up to 10 lakhs in aggregate. That means all persons put together, if there are different people giving up to 10 lakhs, it is exempt. So this has come in by way of a press release. But only issue that we were coming out is, I don't know how we dealt with in financial year 1920, which is already filed. I mean, if it is shown as an income, then I think we have to revise our return, for which the revised return date was also gone through. Can employers claim COVID support as a deduction? The answer is yes, but there is no clarity, is what has been told in this particular slide. The next question, yes, sir.
In fact, coming to the same point, now it is talking about medical treatment. Now, is vaccination a medical treatment, or it has to be treated as perquisite in the hands of employee?
Amount received from an employer for treatment of COVID-19. Yeah. This is not
so
for
vaccination. It's a preventive thing.
It is for prevention. I mean, staff welfare.
Yeah, but again, done for employees, family members.
Employee, staff, family member could be an issue. You are right.
Obligation of the employee met by employer.
You are right. As far as the employee is concerned, it could be coming under the taxable perquisite. Yes. I'm afraid, if you are paying, even in our office, we have taken a stand. Anybody getting vaccinated, show your invoice, collect your money. Because I want, see, maybe can we also argue this way that it is their obligation, but for my protection? Can that be an argument? I mean, why we did that in our office is to say that everybody should be vaccinated before coming here. And if you, I mean, we are going to subsidize your cost, I mean, we are going to bear the entire cost. That is not because of, I mean, while I would like to look like a good employer, but my secret intent is that I should not be infected. I mean, that's the business should go on smoothly. And what is true for my employee could also be true to my employee's family, because if they are infected, my employee will be infected. If he is infected, I am infected. I mean, in that context, can one argue is another.
No, but these things and this provision of some furniture, etc., is becoming a very dicey issue, because you can't call it as a medical expenditure, basically.
Yes, I fully agree with you. I mean, especially since the amount is small, but if there are, let us say, 10,000 employees or 2,000 employees, and you are bearing for all 5, let us say four family, that could be a big expenditure in that sense. Yeah, we go to the next issue, which is on 269 ST. 269 ST, the popular issue, is up to 2 lakhs PTE. I always keep telling PTE. What is PTE? Per person per day, per transaction for any number of days, per event or occasion for any number of days. So I cannot take more than 2 lakhs. I'm not getting into the details of the section itself. But in the case of a hospital, when there is a patient who is who is no more, and his family wants to take the body away, and the family gives 3 lakh rupees, should he take or should he not take? Should the hospital take and then keep his heart aside and say, you get me in the form of a DD only? They have to take the patient. That's the patient in the body. So as an advisor, we had a tough time. Our clients as hospitals, they used to call and ask us, can we take this 3 lakhs? And I mean, what we used to tell them is, maybe ask them to come and give the next day DD and take back this 3 lakhs. Those are all the practical ways of answering. But how do you deal with legally? What does section 269T ST breach talk about? The breach is talked about in 271 DA, which says that you will be penalized a sum of 100% of that amount unless you show good and sufficient reason. And if you show good and sufficient reason why you collected this breach, why there was a breach, then you need not pay. But what is good and sufficient reason? Can this be a good and sufficient reason? In my opinion, what better could be that? However, the department has been liberal only for 2 months. Only for 2 months, that is from 1st of April to 31st of May, to say that a hospital, dispensary, nursing home, COVID care centers, or similar other medical facilities providing COVID treatment to patients. What about other patients, cancer patients or whatever? The relief is not given to such people. To patients for payments received in cash during 1/4/21 to 31/5/21 requires obtaining of PAN or Aadhaar card of the patient and payer, and the relationship between them should also be noted. In that context, you don't have to. Now the issue is not this. The issue is, how will, as a tax auditor, you will come to the reporting. Let me tell you, for a tax auditor, this circular comes to my relief. And this comes to a relief in the next year when I am reporting, because this is from 1st April 21 to 31/5/21. But if such a thing has actually, if the hospital has collected 3 lakh rupees cash and it is shown in the cash book, I as a tax auditor will have to report it as a breach. As a tax auditor, then I may go and sit as his advocate and argue that it is for good and sufficient reason. But for good and sufficient reason cannot be the basis for not reporting in Form 3CD. I hope I'm clear. Form 3CD does not talk about sympathies or exceptions, and he says what are all the amounts on breach of that has to be reported. 269 SS, 269T, 269 ST, all of them have to be reported by the tax auditor. However, for this particular case, in the next year, you don't have to report if the hospital collects it, because it is coming by virtue of a notification. This I've already told you. Rule 6 ABBA has been inserted, talking about normally 3 are told for 40A3, 43, 43 CA, 44 AD, 50 C, 56 210, 80 JJAA, 269 SS, ST and T. They said account paid check, account paid draft, electronic clearing system of the bank. And they have said Rule 6 ABBA, which talks about credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT and B. So all this, so we have got 11 permitted modes now, 3 plus 11 modes. Rule 6DD, very popular Rule 6DD when we are doing the tax audit. 40A3, please understand, for Rule 6DD comes as an exception only to 40A3. Not for 43, section 43. What is section 43, sir? If I am buying as a chartered accountant a computer worth more than 10,000 rupees in cash, that cannot enter my block of asset for claiming depreciation or for future return on value for calculating capital gains. So 43 is very similar to 40A3. 40A3 is for P&L account items. 43 is for depreciable assets, I mean for assets. For assets. 43 is for assets, but for immovable property, 269SS and 269T also comes into picture. 269SS and 269T also comes into picture. The difference between computer and immovable property we need to understand. Computer, if I am buying, I can still make 10,000 rupees per person per day. That means if I bought a 30,000 rupees laptop, if I am giving 7,500 rupees every day, I can probably still take it as a not as a breach of 43. But under 269SS, when I am buying a property by paying 20,000 rupees in cash, anything more than 20,000 rupees in cash in total, when I cannot spread that 20,000 rupees, I mean, if I paid 20 lakh rupees in cash, I cannot spread it between the days. It is 20,000 rupees maximum. That's how it is. So that is the difference between 43 and 269 SS. So that's one point I wanted to say. And the difference between 43, that is a capital asset, or 269 SS, which is immobile property, and 40A3 is, for 40A3 alone, Rule 6DD can come as an exception. Rule 6DD cannot come as an exception to anything else. To anything else, Rule 6DD cannot come as an exception. That's the first point to be noted. And we know what Rule 6DD is. One important point is to the cultivator, grower or producer of agricultural produce. If my client happens to be a rice miller or a paddy, flour mill, then if he is buying paddy or wheat from a grower, cultivator or producer, then only he can come under Rule 6DD exception. If he is buying from a trader, if he is buying from a trader, although it is an agricultural produce, he will not be eligible for this exemption under Rule 6DD. As a tax auditor, I need to know this. And one of the exception which was there earlier in point number J, payment made in cash more than 10,000 rupees on a holiday. On a holiday, that means when banks were closed due to holiday or strike, was covered as an exception. Now, with effect from 29th of January 2020, it is struck off. What is the reason, Deepak? The answer is very simple. Now you can pay on a holiday through any one of those permitted modes. So therefore, this is removed as an exception. In Rule 6DD, I always see one, what should I say, sort of a way out if there is something that we as advisor have to advise, is payment made by any person to his agent who is required to make payments in cash for goods or services on his behalf. That means if I have a flour mill and I have to give it to a trader in cash, I mean, for whatever reason, then can I route it through my agent, saying that in turn he has to pay it in cash? Is that coming as an exception is a point which we need to deliberate. I'm not going to give the answer itself here. So we need to understand the cutoffs. All of us are aware of the cutoffs, but I thought the important cutoffs, how we need to know, is donations received by a political party, 2,000 rupees per person, uska upar liya to it will be taxable. 35 AD capital expenditure is 10,000. 40A3 is 10,000 rupees per day per person. And as I told you, 40A3 and 3A. What is 3A? 3A is very important. I booked it as an expenditure in year 1. And therefore, in tax audit report of year 1, it can be claimed as an expenditure because it is still not paid. But in year 2, I make the payment of 1 lakh rupees in cash. So in year 2, it will be disallowed under 40A3A in year 2. In year 1, you can claim it as a expenditure. In year 2, it will get caught. But for both 40A3 and 40A3A, Rule 6DD comes as an exception. 43.1 we have already seen, actual cost definition for depreciation. 43CA, 50C, 56.210 we have seen that if the consideration is exchanged more than in permitted modes, any amount that is, then it could be 1 rupee also. That should be sufficient to say that transaction was entered 4 years ago. Presumptive profit and 80JJAA we have seen. But why I put up down 269SS is normally we talk about 20,000. One of the chartered accountants was telling, he took a loan of 1 lakh rupees in cash in his books, and he had to go and show those books to the assessing officer. It was called for scrutiny. Then he checked up and he said, okay, 1 lakh, I cannot take it in cash. So therefore, he asked his article trainee to split it into 5. Normally, what happens? So he split it 20,000 into 5. I mean, he said 20,000 I took from A, 20,000 from B, C, D, E. And the chartered accountant did not check up, and he went and placed that book before the assessing officer. He said, this is a good case now. I am going to add 271D per penalty of 1 lakh. Why? Because 20,000 and above. When it comes to 40A3, up to 10,000 rupees, that means you can give 10,000 rupees also in cash. But for 269SS, 269ST, 269T, that 1 rupee can make a lot of difference. So the point I just wanted to bring out through this slide. Residential status. 1920, they gave a relaxation saying that from 22nd March, when Narendra Modi ji announced the lockdown, if somebody is locked inside, he could not have traveled, and you have breached that 182 days, I will not count those 8 days or 9 days for my considering of as a resident. But for 2021, there is no such relaxation. There is no such relaxation. However, they came out with a circular to say, if by virtue of your staying in India because of lockdown, you are not able to go away, you are considered as a resident, and by virtue of some other reason, you are also considered as a resident of some other country, you cannot be a resident of 2 countries. So therefore, using the rule of tiebreaker as told in the double taxation avoidance agreement, we will give you the benefit. But per se, we will not call you, we will not say so many days will not be counted. We will not give you a relaxation like we gave it in 1920 year. Yeah, Finance Act 2021, changes having immediate impact. Yes, this is a very important thing. ESI and PF, employers' contribution. Employers' contribution will be, we were always considering employers' contribution and employees' contribution as 2 different things in income tax. 43B says any delay will be permitted until the due date of filing the income tax return. But for employees' contribution, it will be disallowed the moment it is paid beyond the due date as told under the respective acts. Normally 15th of the next month. As a tax auditor, I don't have a big responsibility. Actual date of payment and the due date of payment. That's all. I mean, amount I have to pay. And based on that, the CPC will add back and send it saying that it is disallowed. Now, for a moment, we'll understand why this differential treatment between the employer and employee. What is the logic? If we understand the logic, perhaps it will be easier for us to understand the section. So in the case of an employee whose salary is 10,000 rupees, I as an employer am contributing 750 rupees as his contribution, as employer's contribution. So I will debit 10,000 rupees as employee cost, 750 rupees as employer's contribution to PF. And this 750 rupees is going from my pocket. So total salary, I am debiting 10,750 to my books of accounts under two headings: salary, employee's contribution to, all of them as employee benefit. But out of 10,000 rupees, I will not pay 10,000 rupees to the employee. I will deduct 500 rupees from him and give only 9,500 rupees to him. Right, sir? This is how it happens. So I will deduct 500 rupees. The moment I deduct 500 rupees from his 10,000, I am putting that 500 rupees into my pocket. At that stage, it becomes an income under section 22410. I mean, that is how it becomes an income under section 2, subsection 24, subsection 10. It becomes income, but will be allowed as an expenditure if and only if it is paid within the 15th of next month under section 36(1)(5). What was an income becomes an expenditure under 36(1)(5), becomes nullified. Actually, 10,000 rupees is the salary which you have already debited and claimed it as an expenditure. This 500 rupees is now coming as a credit to your profit and loss account and will be taxed. But this 500 rupees will be allowed as an expenditure under 36(1)(5) if it is paid within 15th of the next month. Now you see the difference between the employer's contribution and employee's contribution. Employer's contribution you are paying from your pocket. Employee's contribution, what 10,000 you have paid from him, you are taking from his pocket and putting 500 rupees in your pocket. So that is why they stand on different footings. However, in so many words, the act was not told. The advocates went on to confuse the court to say that if what is true for employer should be true for employee, and when the PF authorities are not bothered, they are charging the same rate of interest as penalty for both the thing, why should income tax be differential? That is the argument that they took before the court. Some of the courts, almost all high courts, including Hyderabad High Court, Karnataka High Court, they gave a favorable verdict. They gave a favorable verdict saying that as long as it is paid within the due date of filing the return, it will be allowed. However, from in Finance Act 2021, with retrospective effect, they went on to add 2 explanations, making it now very clear in the act itself to say that the due date for that is different, due date for this is different, they cannot be bundled up. So from 2021, that means for the tax audit, what we are doing now, it will be difficult. Now the question that comes out is, what happens to the earlier years up to 1920? Now there we have a favorable judgment already from the Hyderabad Tribunal, Crescent Roadways, and one more which my good friend sent, Salizer Hydraulics Private Limited. So these 2 things in the tribunal, they have held that for the earlier years, notwithstanding the clarification which has come out. In fact, this has come out as a clarification. Normally, clarifications are said to have a retrospective effect. But in the act, Arun Jaitley, as Pankaj Bhai rightly said, in 2013 itself, he had promised to the parliament that there will be no retrospective amendments. So they said this clarification with retrospective, with effect from 1/4/2020. That means up to 31/3/2020, whatever was the rule of law at that point in time. And whatever law means law as deciphered by the courts. That becomes the law, the precedents. So that law holds good. And that is how Hyderabad has been favorable, has given a favorable judgment. And using this judgment, we can make use of this. Sir, let me tell you, I thought that the Commissioner Appeals will not allow me for earlier years. We had a lot of appeals before the Commissioner Appeals. One of the Commissioner Appeals has given me a favorable order, and 2 Commissioner Appeals have given a against me, which I will definitely go to the tribunal, and using this citation, I will be able to get it. I will use the citation of the another Commissioner Appeals only. All are in the faceless assessment. That means maybe different places are different commissioners are taking different views.
The word stating that it was never the intention is creating all the problems.
Correct. No, it was never the intention from 1/4/2020. I mean, that is how the courts have identified. Yeah. I think that, see, that is how it is. That's how my litigation due to retrospective amendment at the time of budget, I made this. The tax department may argue that the intent of the legislation was never to apply provision of 43B. Yes. And their intent was correct. But then I think
court.
Yeah. And in any case, what we need to take home from this is, from now onwards, we have to tell our clients, salary late pay kar do, audit fee late pay kar do, but employees contribution for PF and ESA pay it on time. You know, they will take the audit fee definitely for the example. The provisional attachment, other things we have discussed, so I will skip all this. Amendments in tax audit reports we have seen. Yes, sir. I have got another 12 minutes. I think instead of getting into the TDS TCS provisions, I can take any questions on TDS TCS, although I will not like to formally present the TDS TCS today. We have got 12 minutes. Let us use these 12 minutes to exchange Any questions?
Okay, sir, please take the question.
You want me to take Deepak?
Yes, sir, please.
Deepak, what I will do is I will just I'll be reading from Q&A. If you have anything important in chat, just you pick up, because we'll try to ensure that everything is covered. Okay. I'll just start from Suri Babu. In case of taxation of derivatives, there is no natural justice because Government of India is losing crores of rupees from the persons who are earning crores of rupees, and government is collecting tax from persons who are suffering losses, except in tax audit cases.
I don't understand the question. Although the question, how do you say that if he is earning through derivatives, all that the government said is it is not exempt from tax. It is not called as speculation. It is not. It will be subject to tax. If you are earning profit from derivatives, it will be subject to tax. However, if you are incurring losses from the speculative trade, you can carry forward that for future or can offset it against your normal business profits. That is what it was told. But if he means that by offsetting the derivative loss from a normal business, it is not correct, then I think we should leave it to the thing, because they felt that they have to give. Maybe that is how the stock market is going up 56,000, 57,000. It's going every day by 1,000 points. Maybe because of all this. But this provision has been there for a long, long time. So we should respect that.
Yeah, Prashant Agarwal asked, for a professional doctor covered under tax audit, is the audit supposed to include non-professional income, rental income, capital gain, and whether the books of accounts will include non-professional income also?
So I would put it like this. You are an auditor for the income from profession. However, if the books of accounts has any one of these elements, then I am afraid that he has to audit that also. If it is maintained separately, you don't have to. In fact, I am not an auditor for the income tax return. I am not an auditor for the computation of income. I am auditor for the business. And I was telling you that in one business, there can be two auditors. If a person has got two businesses, in the case of an individual, I don't know how it can actually get clubbed and filed. That's a different issue. But our institute has talked about an individual. I told you that's why it is not SSC specific, it is business specific. I mean, I took the example of Mr. Reddy, where I said 80 lakhs cement business and 4 crores garment business. Imagine in his cement business, he's doing 8 crores and garment business 5 crores. He decides to appoint Deepak for garments and Pankaj Bhai for cements. They can do an audit, but between them, they have to break a head of how to file the return. But it is possible. So in short, whatever comes in the books of accounts is subject to an audit. You are not an auditor for the SSC. You are an auditor for the business and the books of accounts of that particular business. Whatever comes in that. Saying the same thing, extending the same logic. Suppose 80G donations are not there in the business books of accounts. Should I comment it? I mean, that becomes a very odd question. If you don't bring it in the tax audit report, you will not be eligible to claim that also. So therefore, we try to bring it in the books. If it is shown as drawings, we better bring it. I mean, that's how it is all done. Yeah.
Sir, Adinarayana Kutta, the question is slightly lengthy, so I'll try to be as slow as possible.
Sir.
This is a query regarding reinvestment under 54F of the Income Tax Act.
Yeah.
He says date of transfer of original asset is 5/9/2019, 5th September 2019.
Yeah.
Which resulted in long-term capital gain.
Yeah.
He parked the net sale consideration in capital gain account to buy a residential house.
Okay.
Now, I have to buy the new house by 4/9/21.
Yeah.
As per the time limit specified under 54F.
Correct.
Which has not happened.
Yeah.
Sir, is there any extension of time limit for reinvestment under 54F due to ongoing pandemic situation?
Sir, this is 25th June 2021. There was a relaxation for 254 GB, all investments, but falling where the due date falls between 1st April 21 to 29th September 21. Unfortunately, he's coming on 4th September 2021. So his due date stands extended to 30th September 2021. So for a few days, that means 27 days only, he's getting the benefit. Wish that, I mean, if he had sold a few months earlier, also he could have got 30th September only. So in short, if the due date falls between 1st April 21 to 29th September 2021, then it stands extended up to 30th September 21. However, these are all problems. You can still write to the CBDT and ask them to extend this if it is a big amount, and work accordingly. And we always say, as long as if you have made the payment to the builder or to the seller, it is sufficient. It need not necessarily be registered in your name on that particular date. There are favorable judgments to that extent.
Though ideally I would not like to read questions from anonymous attendees, I'll still take up one question wherein they are asking about if the credit card payments is in lakhs and it is showing in 26 AS as SFT transaction, what is to be done by SSC?
The SSC has to reconfirm whether that particular expenditure is that of his, number one. And he also has to know that the department knows about your expenditure. And if that expenditure is, let us say, for travel, for business purpose, then it is to be shown under the respective heads. Otherwise, if it is, let us say, for house electricity or for buying jewelry or for buying saris, and then he has paid cash for settling it, or somebody else has paid for it, it will all have to be shown as drawings. That means he should have that much of accounted money with him to have spent that particular money.
Basically, they are trying to check whether the income is proportionate to the credit card. Yeah.
Perfect.
Right. Sir, Avinash Poturi asks, can foreign travel expenditure be claimed against foreign dividend income?
We already answered this.
Yeah. Right. And M. Karimullah says, can tax audit be done without or before statutory audit is done?
It can be done. It can be done. It can be done. But you should use Form 3CB. That means
even for companies?
Yes. I mean, that is also one of the things which is envisaged, that even for companies, you may carry out your tax audit, but the statutory audit has not commenced, or for whatever reason, then you can do it that. But please, at that stage, you'll have to use Form 3CB and say that the financial statements are also audited by me, and then do the tax audit.
Raghupati Rao CV, if for the previous year 2021, deduction under 43B is not allowed, would the deduction be allowed on actual payment?
Yes, sir. Definitely yes. Definitely yes. But the point to be noted for 43B or 40A1A, in year one, okay, you can get the benefit of paying it till the due date of filing the income tax return. But in year one, it is disallowed. And in year two, you have paid. The benefit in year two will be allowed only up to the end of the year, not till the end of the due date of filing the return for year two. I hope I made it clear. Suppose, I mean, I don't think I need to explain, right? I think it's clear in itself.
Actually, Avinash comes back and says that there is no provision need to file a revised tax audit report in the new site. Yeah, of course, we all know. Yeah. And there's another anonymously, he has written that there are a lot of problems in IT portal and we are unable to submit so many reports, complaint notice. So who will be held responsible? The big question made short.
Yesterday, I was, before you came, I was also discussing with the other team members. Guwahati or some place, the advocates have filed a writ with the High Court saying that they have to, the income tax department has to give a certificate saying that all the filings electronically as envisaged in the Act is proper. They have to give a certificate, and if they don't give a certificate, they have to go back to the old portal, or from the time they give that certificate, they should give us 2 or 3 months time for filing the returns. So it is coming for hearing, I think, next week. It will be a very interesting thing to see.
Deepak, would you like to just take up from chart also? Deepak, you are muted.
Pankaj sir, one more question also there in this one.
Yeah, there are some more, but chat lo ek question hai.
Yes, sir.
Yeah.
I've jotted out the question, sir. Sir, is NPS allowed under new tax regime reduction?
What is NPS, sir?
National, yes, the employer share is allowed, but the employee share of 50,000 is not allowed.
Perfect.
For F&O turnover, it includes only some of favorable and not favorable differences, but also sale value of F&O to be considered. I read it on a Zerodha stockbroking website. What is correct, sir?
No, what is the sale value thereafter? Once you square off the transaction, what else is the sale value? I mean, I would say Zerodha is not the person. Our guidance note on the tax audit given by the institute is very clear on that. Favorable and unfavorable. What else is the sale value? Apart from what is favorable and unfavorable, will there be a sale value?
He is trying to say the gross value of the transaction, of the purchase and sale for turnover calculation.
No, like in my example, I took the example of Infosys. 1 crore became 1 crore 20, and 2 crores became 1 crore 50. When 2 crores my book kiya tha, but 1 crore 50 is what I finally became, and therefore, so actually there is no money going up and down. I am only saying that I want to buy, please buy 1 crore worth of, the derivative. I don't actually send, it is only if at all, it is a deposit given and deposit taken. The deposit given and deposit taken cannot be a turnover.
Maybe the questions are coming because I also faced a similar thing, sir. In the compliance portal, what department has put, they have put 2.7 crores, that is 1.5 of this and 1.2. So, and the figure what was shown in that exactly matched. Okay. And when we are taking only the margins, there, and even if we are going, they're subject to tax audit for some reasons. What is happening is the holding or the unsquared off transactions are creating a problem. So it's better to go with the 2.7 crores than the 0.7. That's why I said for deciding the turnover, this margins is criteria, but for accounting we can take for the total things.
While I leave it to you, even if you are doing that 70 lakhs as a turnover and you hold good with that, you can still prove your point by giving the guidance note of the institute. Guidance note of the institute cannot be belittled in that sense.
Can we file tax audit report for all the business, or each report for each businesses?
See, this is all theoretical. When I would say at the end of the day, this is theoretical. I would say it should be for all the businesses under one. And if he appoints 2 auditors for 2 businesses, then it will be practically not feasible. While theoretically it is possible, let us then say that both of them will come together and one of them will file on behalf of the other.
Turnover is 9
like
crores.
I would say, it is very similar to what we do in consolidated financial statements. 2 auditors do it and then give it to a consolidated auditor to file it. That would be a practical way of doing it.
Sir, turnover is 9 crores. All conditions of 44AB is satisfied. Maybe that 10 crore 5% is going to extension 10 crore. 80J AA claim is made. Is report in form 10A mandatory?
Form in 10A. Wait, 10A, what is 10A?
10DA.
That becomes a very, now it becomes the auditor's response. See, 10DA is definite. One of the conditions for claiming 80JJAA, I did not tell you, is filing of the report by the chartered accountant, giving the computation. Now it becomes the chartered accountant's responsibility to say that whether his claim is correct and whether first of all, the SSC has not done the audit, is not eligible for 44ABA. For under 44AB. So I would resist from giving 10DA. I would resist from giving 10DA because on a plain reading, he is not permitted. Maybe if I give form 10DA also, I will give the computation and give somewhere in the remark that the assessee has complied with all other conditions except that he is not this thing. So let the department decide whether 80JJAA has to be given or not. I mean, some via media, so that we work out and bring it in the knowledge of the department.
The turnover is less than 1 crore. Taxable income exceeds threshold limit. Is tax audit mandatory?
Come again, sir. Sorry.
The turnover is less than 1 crore.
Okay.
Taxable income exceeds the maximum amount chargeable to tax.
Not required. If he's, let us be very clear, whether he wants to go for 44AD or no. If he does not want to go for 44AD and he has not gone earlier, then he need not get himself audited. Books of accounts maintain correct.
Deepak, more than 3 hours, sir is talking.
Yes.
I know questions will not stop, Deepak.
Yes, sir. We'll have to stop, sir. The questions are
Yeah.
coming like continuous, but we'll have to stop.
No problem. So, Deepak,
Yes, sir.
will you close? Okay,
Sir.
I'll do one thing. Sir, one thing, I can tell you one thing. Why I was always wondering why our profession, they call it as practice. And I think those who have been hearing you would have understood by now why we call it as practice and why we cannot become perfect to perform. So that's where the CP committee and all becomes important. I think one of the excellent presentations which has happened, wherein you have tried, the way you have gone through section by section is a real example for all of us to emulate and at least try to reach or try to do what you're doing. So I think, sir, it was one of the excellent things. I know there are many doubts which are coming after hearing you, but yes, friends, if we are able to take out the books, read, and then in our direct tax study groups, if you can just put those questions, maybe we will call Acharyaji one more time at some other place, because he's one of the excellent persons who has never said no. At least to Hyderabad, I know he has not said no, and he's one of the finest persons we ever had. So, sir, thank you very much. 3 hours, and your energy and your stamina also is great. We need to learn from that also. So I'd like to just hand it over back to Secretary, sir, to finish the formalities.
So before you hand over the session to the secretary, I should thank each one of the panelists. It is because of your interaction and your actually being on the screen as much as I was, this session became so excellent. And if at all, having said that, since you mentioned about the practicing chartered accountants, I told this last time and I would like to reiterate that a practicing chartered accountant does not just mean practice makes a man perfect. You know, if practice makes a man perfect, then when will we become perfect chartered accountants? We are in fact perfect in that sense. Having said that, practice what you preach. That is the practice that a practicing chartered accountant is. That is the prefix that comes out. We don't just preach. We also practice what we preach. I think that is the message with which we are called as practicing chartered accountant. And in the light of the faceless assessment, I think it is only those practicing chartered accountants who can really thrive. If they are just preaching chartered accountants and not practicing in the true sense of what they preach, I think that will be known sooner than later in the case of faceless assessment. Because in the faceless assessment, all of us are aware by now, and sure, by now what we know is only a element of it. Going forward, it will be only pure knowledge-based practice, rather than knowing-based practice. You know, knowing the officer, I always tell, is the days are gone. And interestingly, we had a video conferencing also, wherever there were big additions. Last week we had a video conferencing, and our skills will come to the fore when we convince them through the writing. Of course, that's a different skill in itself altogether. How do you write and convince the officer? But we should understand that we have all written the CA exams and passed the CA exams. We have not really, faced the Viva exams in that sense. So we are good in writing, but only thing is what is required is constant upgradation and updation. Because the laws are changing so much that only if we upgrade and update, then only we will be good in writing. And afterwards, if something is missed out, we can always call for a VC hearing on the Faceless portal. They will in fact come. In fact, one day they gave us the time, 3:30 they said. 3:30 to 5 they did not come. When we were putting the screen and we just left, let us see what will happen. Then we wrote a mail to them. 3:30 to 5 we were there on screen. Nobody came. Then they sent a very next day a mail saying that after 2 days they said 3 o'clock and they were there at 2:50. So in that sense, we made our presentation. So I think going forward, this is how it is. So thanks, Hyderabad. Thanks to the pearls that are sitting in front of me and all the listeners for giving me this wonderful, enriching experience. Thank you.
Thank you. Thank you, Guru sir. As your name suggests, Guru and Acharya, you preached all of us in such a manner, we won't forget you. As a token of appreciation and gratitude, I request our Vice Chairman, C.A. Deepak Ladda, to present the virtual certificate of appreciation. Deepak ji.
Sir, kindly accept small gratitude from our side, from Hyderabad branch committee, managing committee member, sir. It was very honor and privilege to have you today virtually. Although it was virtual, but for a fraction of a second, we never felt it was virtual. It was equally interactive and equally knowledgeable, in fact, more productive than the physical, sir. Thank you so much.
Thank you.
Over to Secretary, sir.
Thank you, Deepak ji. Sir, as a protocol and it is an honor to offer vote of thanks on behalf of our branch. Sir, what a wonderful, powerful and energetic presentation, sir. We really blessed to hear from you. The way you take up the questions and the way you explain the sections and the case laws and so patiently, we are very thankful to you, sir. On behalf of our branch, once again, we are thanking you for accepting our request. Dear members, thank you for your active participation and Pankaj sir for closing remarks. Thank you each and everyone. We are meeting tomorrow again on GST seminar at 5 p.m. on GST intermediary services by CA Manindra Kakarla. I request everyone to join tomorrow by 5 p.m. With this, we are signing off for today. Thank you once again, each and everyone. Thank you, sir. Good night.
Thank you, Gururaj, sir.